Phyllis, good to see you. All right, well, it is 8:02, so I'm going to get started. We have a ton of people on here, so let's get rocking. So I'm going to start with my mission. So why am I putting on this event? Why am I on here at 8 a.m. on a Wednesday morning talking to all you folks? So about 5 years ago, I was working in corporate, had a great salary. My husband had a great salary, but we knew nothing about investing, like literally nothing. We had taken a bunch of real estate courses. We had been dabbling in real estate investing in the single family home space. We had been losing money. So we had been taking action, but losing money. So to me, that means we didn't really know what we were doing. And we had been taking courses and stuff like that, but we weren't applying it correctly. And so then I started to follow people who did these sort of things, but experts who had actually done it. So people who were extremely successful in real estate. I followed them. I looked at what they did. People who were really, really smart, cutting edge on tax strategy. I listened to them, figured out what they were, the strategies they were giving to their clients and stuff like that. And so I was learning, I learned, and then I applied it to my life. And then I was able to retire from my 9-to-5 at 40 years old. And now my goal is to retire my husband in the next couple of years. And so before I started learning all these investing strategies, tax strategies, etc., and paying attention to it, my money was coming in, but I wasn't paying enough attention to what I was doing with it afterwards. And so I would lie in bed at night with anxiety, like how long is this rat race going to last for me? And I'm not trying to say that 9-to-5s are bad at all. I'm saying that I didn't know how I was going to transition from working really hard to one day being retired and still maintaining the same lifestyle. I was just really worried about it. And some people don't worry about it. That's not they're not worry personalities. I'm a worry personality. So it gave me anxiety. And as I started to learn more and more, actually got more anxious because I was like, whoa, this is such a big space. There is so much to learn. And if you get it wrong, there's a lot at stake. And so as I learned more, I got more anxious. But then there was a tipping point. And once I got over it and learned enough to be successful, then I was like, oh, I applied the strategies I learned, the income that we had coming in, we had invested it wisely. And a lot of the strategies we're going to talk about today and tomorrow are the exact strategies that my husband and I used in our investing portfolio. And so that's why I put these events on, because it created a shift in my emotions in my life. And I want that for other people. This event is going to bring, there's a whole bunch of different speakers speaking a bunch of different things. But the point of each speaker is going to be to give you a strategy that you can apply in your life to shift the way you're investing, whether to make you more money, to save you taxes, to do more due diligence so that you feel more confident. And really, it's the goal of everyone who's going to be speaking at this event is to make you feel confident as an investor that A, you're making the right choice when you are investing, and B, that you know what you're doing and that you're going forward with the right team in place, with the right investments for you. And that is just all of our mission. So I want to say congratulations for being here. Congratulations for marking 4 hours today and 4 hours tomorrow off your calendar to learn from the experts. So again, the speakers that we have coming on, they're not, just like random people who are out there on the internet. They're people who are actually experts in their field. And so even though I learned a lot up to this point in my life, laws are changing, tax laws are changing, real estate rules are changing. Everything is always changing in life. So even after you retire, if that's one of your goals, one of the reasons you're here is to start planning retirement, or maybe you're already retired and you're looking to up level the level of luxury in your lifestyle or extend it, something like that, you always have to be continuing to learn. So even after you retire, you're not fully retired because now you're a money manager. So that money that you've built up in your life up to this point, no one's going to care about it as much as you're going to care about it. So you have to learn as much as you can. It's always great to have people on your team as well. For all those nuances, you can't know everything, but you need to know enough to make good decisions and then have a good team to help you fill in the gap. So, you need to know tax strategy so that you can make decisions on your own, and then also have a great CPA to confirm that what you're doing is reaching your goals. CPAs are great, tax strategists are great, but they don't know, the deep emotions or a lot of the deep details of what you're doing unless you have, a really fantastic tax strategist who meets with you weekly, because we're making weekly decisions, aren't we, about our money, weekly, if not monthly, how we're spending it, how we're investing it, how we're giving it, what entities we're holding our money in, all these things. So it's very important. And then also markets are always shifting, right? So if you know an investment strategy, it could have been amazing for the last 5 years, and it may be the wrong strategy for the next 5 years. And so we're going to talk about some of those shifts actually in these next 2 days, because it directly affects the type of investing that I have really grown my net worth in. And, I have to pay attention to what's going on in the political environment, because I have to know how it's going to affect my investment strategy. So we're going to talk about that. We're going to share it. And so my point in saying all that is I really encourage you guys to follow these speakers after this event, especially those that, really resonate with you, the way that they speak, the way that they educate, the way that they train, because they all do, a massive amount of training for their own audiences on the topics they're going to speak of. And so, they're all going to offer you kind of gifts or ways to follow them in the future. And I really encourage you to do that, because you have to continue to learn. You have to continue to always learn as an investor. So for instance, there's a new tax law. It's 800 pages. Am I going to read that? No. So I follow the guy who's going to read that and tell me the 3 bullet points that are going to affect my investment strategy. So I really encourage all of you to do the same. Okay, so I'm going to talk now about, the agenda, the logistics for the next 2 days. So it's 8 to 12. Pacific time today and tomorrow. We are going to record everything. I know a lot of you have fantastic jobs and you need to take meetings here and there. So a lot of people always ask, is this being recorded? So I'll say, yes, it's being recorded, and I'll share it out at the end, and it'll be up through the weekend. So I don't leave it up forever, but the recording will be shared out. Everyone on here, I have your email address because you registered. So I will send you the replay. You can share that with whoever you want. It's not secret. It's not proprietary. You can share out the replay. You can listen to it again on the weekend. You can listen to it on fast forward, because 8 hours is a lot of information. I know a bunch of people who do that, who put it on like 1.5 speed, and then, they go for a bike ride or they run and they really ingest it all. So that will be sent out. And yeah, so each day we're going to have 4 speakers. So today we're going to have Marco. He's coming up in 20 minutes. I believe he's the next one. We have Forrest, Ivan, and Mike. So they're going to talk about investing strategies, investing like a family office, investing in real estate, investing philanthropically. You guys all got the email with the agenda. These are all people who, like I said, they are experts and extremely successful for themselves, and also extremely successful for the people that they are helping invest. So it's going to be a great lineup. And what I'm going to talk about this morning before the first speaker is how I made my wealth in real estate. And that was through multifamily syndications. So I'll briefly explain what that is, if that's new to you. I'm not making any offers. No one on this 2-day event is going to making any offers of specific investments. We are all going to talk about the model of our investments, the benefits, the pros and cons, who they're great for, what they are, so that it can kind of open your mind to, oh, I didn't even know about that as a possibility. That would be great for me. And also, I want to let you guys know that next week I'm going to do a 3-day challenge, and it's going to take a lot of what we learn in these next 2 days and put it into action. So you'll get an email follow up with a link to that. It's going to be Wednesday, Thursday, and Friday next week, noon to 10 PST, no, sorry, 9 to 10 PST, which is noon EST. For those 3 days, we're going to cram it into an hour, and it's going to be workshop style. So, a lot of people come to these and they listen and they listen and they listen, and they go about their daily life. So what we're going to do in that 3-day challenge is really, we're going to have worksheets. We're going to write stuff down. We're going to make goals. We're going to figure out what type of investing is right for you based on, a lot of what we hear today. So over time, I've now studied 15 different types of real estate investing. And so I'm able to kind of point it out to people and say, this is good for you if this is your goal. This is good for you if this is your goal. It's not a one size fits all. What I have focused on is great for me. It's great for my mom. It might not be great for, one of you listening. But the point is, let's open it up. Let's apply what we learned to our lives and take action to up-level your lifestyle today, or up-level how you're investing in the future, how you're retired in the future. Okay, so multifamily investing, how does it work? What is it? What's a syndication? So basically, I'll lay it out. This is, who is this great for? So investing in a syndication is great for someone who wants to do zero work, besides due diligence, which you have to do. And I'll teach that in the 3-day challenge. It's great for people who, a lot of doctors, lawyers, people who are in corporate, who have great income and they are really focused on their jobs, and they just want to put their money somewhere and have it grow securely, passively, with tax advantages. It is not ideal for people who have a smaller amount to work with. Usually those people should be investing in something more active where you can make higher returns. And again, we'll talk about that in the 3-day challenge next week. Currently, you can invest using your IRA, your 401k, trusts, nonprofits. Pretty much any entity can invest in apartments via a syndication. And so it's really flexible in that way. Currently, there are some rules. Like I said, you always got to keep learning. There's some things that might be changing in the near future that will affect that. But for now, syndications are great for people who want to passively invest, who already have some money saved up and they want it to grow. And again, who want to be totally, I don't want to have my name on a loan for real estate. I don't want to deal with tenants. I just want to put my money with a trusted team and go. So here's how it works. So this is what me and my partners do. I originally invested in syndications passively, and now I'm on the active side. But what we do is we find an apartment building, and we put it in an LLC, and basically private investors are members of that LLC and have equity in that LLC, which has passed through ownership to the apartment building. So we'll pool together maybe 40 or 50 investors. We basically pool everyone's money together, and that's the down payment on a large apartment building. And so in an LLC, you have the general partners and the limited partners. So the general partners are going to be the ones who have their name on the loan, are responsible for anything regarding the tenants, who are responsible for everything, actually. And the limited partners have zero responsibility for loan, tenants, making any decisions, but they do have equity. And so it's a pretty cool win-win for everyone involved, because it allows, for instance, me and my partners to buy more apartments than we can with our own cash. We'd only get so far if we use just the cash that we personally had in the bank. And for private investors, it allows them to participate in apartment investing, which is, proven through different real estate market cycles to be one of the most secure and predictable investments. And so that's why I started investing in those, because I am risk averse. I want something predictable. And so you can find that in apartment buildings, because when the purchase happens, there's a 3 to 5 year business plan that goes along with that purchase. It's not just like, oh, I found this, I'm going to buy it, you guys want to jump in. We do a full on financial analysis of where the property is today, where we can bring it in 3 to 5 years, and what that payout looks like for investors. And so the cool thing in apartment buildings is that you have rent. So rent can be passed through to the passive investors. So all the investors who put their money in, they get quarterly checks. So their portion of the profit from the rent. And then at the end, when the property is sold, then all the investors get another check for the capital gain, so the appreciation. So part of that business plan is to increase the net operating income over time, to increase the profitability of that property, so that then when we go to sell it, we sell it for a higher price to the next buyer, and then all the investors cash out and get that capital gains bump on the back end. So it's really cool. It's really perfect for people who want some passive cash flow and want to participate in appreciation. They want to participate in their investment growing. So, some investments, they have a great back end, like a lot of startups. If you pick them correctly, you don't get cash flow, you don't get passive income from them. However, you can have a great payout on the back end, right? Other investments give straight cash flow. So a lot of debt positions, debt investing, you'll have cash flow from that. You don't have a big payout of capital gains at the back end when you're in a debt situation. So, that's why it's really important to take a look at what's important to you right now or in the next 5 years. Appreciation of your wealth. Are you really building your net worth, or is cash flow more important because you are retired, you're getting ready to retire, or you're wanting to up-level your lifestyle today? So if you're in the category, again, where you would like some passive cash flow and you would like to participate in appreciation on the back end, going into some sort of syndication would be very ideal for you. And so when you're taking a look at these, if you're like, hey, this sounds great, it sounds ideal, I'd love to put it in my IRA, or I'd love to invest with, the money I have in my savings account, you're going to want to find a group that you really trust, because when you're doing due diligence, when you're going to be a passive investor, you're totally passive, meaning you can't make decisions. You can influence by talking to the managers, the management team, but you're not able to make choices for the property or for the investment. So you really, really want to do due diligence on the management team when you're doing any sort of passive investing. So a lot of people on this 2-day event are going to talk about passive investing, because there's a whole bunch of different types. So that is your first step in doing due diligence. And I want to encourage you to go beyond what the time that you're spending with us today and tomorrow. So if someone resonates, their type of investment resonates, do due diligence. So due diligence, I always suggest that they come, you do it in 3 phases. And a lot of times people do this totally backwards. But first, I say do due diligence on the team. So first, find some team that has an amazing track record. Verify their track record, check references, do background checks on them. Really, do they know what they're doing? Or are they, a talking head on the internet somewhere? It is extremely important. So when you do due diligence, especially looking at track record, you want to look at not only what did they do, but what did they say they would do versus what did they actually do? And that's really important. So, what were the projected returns when the investors put their money in, and what were the actual returns that they got out? That is a key thing. And the number one thing that I looked at when I was an LP investor, I still am, but when I was starting out, because if you pick the right team, they know way more than you do about how to choose a market and how to choose a property, right? And so really do pick a team that is fantastic. Teams are often quite large. It's not just one person. I get into these deals. They're really big. They're, $30, $40 million properties. So we have maybe 3 companies going in as the management team. So don't do due diligence just on one, but all the managing partners, the property management company, really look into them. So once you've done that, then I suggest looking at the market. So that's the number two thing that can go sideways, is if you pick the wrong market. So if you pick a beautiful investment because it's beautiful, but it's in a market that doesn't have the right job growth, it doesn't have the right household growth. Oh, I see a bunch of questions. I'll get to those in a second. Okay. So you want to choose a market that has the job growth is higher than what's going on in the rest of the US. Definitely 2% year over year, as it's, as what's happened in the past and what's projected in the future. You're going to want to choose a market that has increased households and increased population. So this applies to no matter what kind of real estate investing you're doing. If it's single family homes, if it's debt, it's equity, it's apartments, whatever it is, you want to see that the number of homes is increasing. So I'll give you an example of the difference between household growth and population growth, and why it's important for you to pay attention to those when you're choosing a market to invest in. So you have Sarah and you have Theo. They are in their own apartments. So you have a population of 2 and a household of 2. They get married, they buy a house, they live in it, and they have 2 kids. So now you have a population of 4 and a household of 1. And so you want to pay attention to both statistics. They're important to look at. I would rate household growth higher if you're in the rental market and in the appreciation market as well. So really look at what's going on in the job market and the households, and the demographics. Make sure it's the right demographics for the type of property you're going into. And then you want to take a look at the property. So for instance, if you were looking at an investment with my partners and we give a deck out to everyone that has, it's often up to 50 pages of our business plan with pro formas. What are we doing to, over the next few years to make the property better, increase the revenue, decrease the costs, and what do we think the net operating income will be when we sell? So something important to know when you're investing is, do the type of investment you're going into, is it going with market cycles, or is it dependent on the actual property? So for instance, single family homes, they do crazy things, right? They go up, they go down, and they can go quickly because it's a direct correlation to what's going on in the financial markets, and also what's going on emotionally for people. It's emotional buys lots of times in the single family home space. It's not always 100% rational. When you're buying an apartment building, there are cycles to it. However, the purchase price is based on net operating income. It's a business. So it's closer to buying a business than to buy in a single family home when it comes time to determine the price. So the purchase price is there's a formula that we use, and the variable is net operating income. So that's why it's so important to focus on the business plan and look at that net operating income to see how it can be adjusted. How can the revenue go up and the expenses go down to get that operating income up so that the sale price in the future will be higher? So that is the order of due diligence. And again, next week when we do the 3-day challenge, I'm going to have checklists for how to do due diligence on investments, how to do, checklists for people, checklists for markets, checklists for property. So you can start practicing and seeing, okay, a lot of the investments that people are talking about today, let me see how I can dig in a little more to see if they're right for me and if they're good investments, that sort of thing. All right, so we have about 5 more minutes until we have our first guest speaker. So I'm going to pop over to the Q&A in the chat. I see a bunch of things and I'll answer some questions. So also to say, at the end of each speaker segment, there's going to be about 10 minutes for Q&A. So feel free to put questions in the chat or the Q&A, and we will address those at the end of, if the speaker has a presentation, we'll jump into those. Okay, so I see people asking about the recording. Yes, if you jumped in late, there will be a recording. It'll be up until the end of the weekend. So you'll be able to access it if you have to step out for a meeting or something. I know we all have busy lives. All right. Question about syndications. Do they require investors to be accredited? So this is a really good question. So accredited investor, for those of you who are new to the concept, means that you have a net worth of $1 million or more, or you earn an income of $200,000 or more per year, or your household, you and your spouse together, earn $300,000 or more per year. So it's a or. If you check one of those boxes, you're an accredited investor. So some syndications are organized as what's called a 506C, which means is open for accredited investors only. And we can advertise and do marketing for those. And then there are others that are organized as the 506B, and those we can offer to non-accredited investors as long as we know them. So after the 3-day challenge next week, I'll be giving out a link to do a half-an-hour strategy call with me. And so if you're non-accredited, but you're interested in investing, we need to have that phone call first. And I basically get to know you, what you're looking for. And if I decide it's a match, then in the future, when we have a investment opportunity, then you can participate. Okay. How much is the typical range of investment needed to be on the limited investor side? So yeah, usually, so there's a lot of stuff out there. So for our projects, it's usually between 50 and 100,000. There are a ton of crowdfunding websites these days that have 5, 10, and 25K as their minimum investment. So, I don't have a particular crowdfunding website that I would recommend, but there are a lot out there and they're growing in numbers. So if you're interested, it's usually 50 to 100K. If you're going with an individual group, when you find someone and you sync up with them, that's usually the range you see on crowdfunding websites, because they have like a whole back-end team just for the investors. They can drop it down to 5, 10, or 25K. Okay. All right. And then more of them are just saying thank you. So you're very welcome. You're very welcome. I'm going to jump over to the Q&A. Could I organize a residential co-op inside an LLC? I'm not sure what a residential co-op is. If you're talking about that type of like a piece of property that's a residential co-op, and can you put that in an LLC? I would think so. If you're talking about something else, I'm not sure. So let me know if that answered it. Okay, then another question is, where the shareholders live. Okay, I'm not familiar with that model, so I don't have any advice on that one. What risk? Okay, so asking about the risks of a syndication. So the risk of the syndication, where I've seen it go wrong, the biggest thing is with the people, with the property management team. So a lot of times people will do diligence on me, but not, or the folks like me, the sponsor, the syndicator, but they don't do due diligence on the property management company that's being used and how are they integrated. So that's the only time I have lost money in real estate is due to bad property management companies. So that is the biggest risk that I see. Either the team is not really invested in the success of the project. So that's another thing you can check, like how much money does the GP team have in there? So I always put my money in all of the projects, and so do my partners. So are people you're investing with, are they doing that? Is their own money at stake? That's a great way to really make sure it's a lower risk situation, because they're going to pay attention if it's their own money, right? But yeah, I'd say the biggest risk is choosing the wrong team and then choosing the wrong market. If you misjudge the market and the rent goes up 1% per year, and you have a business plan that you're going to increase it 3% per year, and you totally misjudge the market, then you're not going to reach your profit goals. Okay. When they say they will do something, how are their feet held to the fire? So I assume you're meaning like the management team. So something very important to look at, and again, we'll talk about this in the 3-day challenge, is how during due diligence, there's a private placement memorandum, and in there is what's called a waterfall. So it shows you the order of payout of the profits, basically. So on all of ours, when there's, at the end of the quarter, the investors get their returns first, and then the managers get the returns second. So that's our incentive to make sure that we have the property performing top notch, right? And then at the end, when the property sells, same thing. So first we pay back the loan, then we pay back investors' principal, and then we pay back investors' returns, and then we pay ourselves. So we're last. So that is the way our feet are held to the fire. If the property is performing poorly, we've basically worked for 5 years for free. We haven't made any money. So that really aligns our interests. We are, so hyper-focused on making sure that the property performs better than expected, because on the back end, we don't get paid till you guys get paid out, what we said we would pay you. So another question is, I'm interested in putting together syndications. Do I need a real estate license or a Series 7 license? No, you don't. You don't need a license for putting together syndications. However, I would highly suggest that you take a coaching program. There's a ton of great ones out there. Multifamily Mindset is a fantastic one. The coaches are great. The training is great. There are so many nuances in putting together a syndication that I would highly suggest that you take some training and don't just jump in. Also, you want to make sure you do everything legally. The SEC does scrutinize how these are put together and managed and marketed. So you don't want to get in trouble and slip up and do something wrong that you didn't know was wrong. And that can happen easily. All right. Any other questions for me? It looks like we answered most of those. So, all right, I will wrap it up for my segment, and then I can bring on Marco. Marco, are you here?
Hi, Sarah. Yes.
Hi, welcome. Do you want to go ahead and turn your camera on?
Yep.
All right, looking fantastic. How are you today?
I'm doing great. How are you?
I am doing good. I have my volume really low, so I can't hear you. There we go.
Can you hear me now?
Yep, there we go. I'm sure everyone else can hear just my own. Well, thank you for being here, Marco. I'm really happy that you're here. You have so much wisdom to share with this audience. And I did want to say, you guys, this is co-hosted by Eddie Wilson and myself, and he's going to pop in throughout the event, and he's going to give his talk at the end. So Marco knows Eddie, they're friends. And so that's how we were introduced. And I really appreciate the introduction and you spending time with us today. So Marco, I'll pass it over to you, and you can do a little introduction about yourself and your company and what you do and how it relates to investing confidently.
Sure. So I put together a PowerPoint presentation. So I'll share my screen
Okay.
and I can do that right now, and then we can do a little Q&A later if you want.
That sounds perfect. I'll turn off my video and let you have the stage. And there you go.
Okay, I think you need to enable my screen share first.
All right, let me.
And then we will be good to go.
Okay.
Got it? Okay, there we go. All right, cool. So let me share that. Let me know if you can see that, Sarah.
Yes, we can. Looks beautiful.
Cool. Okay, good stuff. So, well, welcome everybody. Glad you guys are taking the time to invest in yourself and be on here today, because the more you learn, the more you earn, as they say. So this is going to be great. I have a lot to cover in a short period of time. This is something that I would normally cover in about a 2-hour period. So I'm going to apologize in advance and say that I'm going to be talking quick, but I'll make sure that you absorb as much as you can. So what I'm going to talk about is how to build a passive real estate portfolio from anywhere in the US. And this is something that I did personally from 3,000 miles away, living in Southern California, investing in 3 different states on the eastern side of the US. And yes, I fell down and, got scratched, burned, sometimes even ripped off by contractors doing different things. But you learn from your lessons, you get up, you brush yourself off, and you move on, and you take those lessons and become stronger and learn from it. So let me start off by taking about 30 seconds to tell you a little bit about who I am, to kind of set the stage, and then we're going to dive right in and not waste any time. So I consider myself really a serial entrepreneur, but for the sake of today, I'm a full-time real estate investor. I'm an author, and I'm also the founder of Norada Real Estate Investments. It's a company I started about 17 and a half years ago to help other real estate investors do what I was doing at the time, and that's to invest in some of the best markets around the United States, regardless of where you live, and that's just being area agnostic or market agnostic. So today we're a nationwide provider of these turnkey cash flow investment properties. I started at the age of 18. That's when I bought my first rental property, and I literally had to wait until I was 18 because I couldn't get financing as a minor. so I wanted to actually start earlier, but that's when I started this journey. And then in 2004, I spent a lot of time going full time, and I acquired it was 84 doors in 9 months. So and those weren't apartments; those are mostly single family homes, duplexes, and fourplexes. So I hit the ground running very quickly at that point in time. And last but not least, I'm also the host of the Passive Real Estate Investing podcast, which is typically rated in the top 50 of all the business podcasts on iTunes. And I designed the show to be specifically geared towards people who are busy, who have, full-time jobs, families, they're, living their life and doing what they want to do, but they still want to invest in real estate and learn how to do it and avoid the pitfalls like I fell into early on. So often when I'm in a room, I always ask investors to complete this sentence and, just shout the answer out. Now, we can't do that obviously here because everybody's muted. But I asked the question, ignorance is blank. And what do you think most people say? Sarah, do you want to take a stab at this out of curiosity?
Yeah, and I would say everyone put what you think in the chat as well. It'd be fun to see what everyone thinks in the chat. I would say ignorance is dangerous.
Well, that's actually a great guess, and it's pretty close to what I want to say. But what most people say is ignorance is bliss, because that's what we hear, right? Everybody says ignorance is bliss, and as if that's like a good thing. But the reality is, and the way I look at it is, ignorance is expensive.
Yes, look at that, Susan in the chat. That's what she said. A lot of people say costly. Very costly, expensive. There you go.
Yeah, it is. So, so what you don't know what you don't know, and what you don't know is typically an opportunity cost. It is costing you missed time, missed opportunities, missed investments that come and go, and you don't even recognize them because you don't know what you don't know. So you can't even identify a good, bad, or a great investment opportunity. So they're saying is the more you learn, the more you earn, and that there's a lot of truth in that. So it's important to invest in yourself first and foremost. You want to invest between your ears before you start investing your hard-earned capital into anything else, whether it's stock, bonds, mutual funds, real estate, or otherwise. So knowledge, I like to say, is the new currency. It really is important to build your knowledge, your brain, your investing skills, your due diligence skills, anything you can, because the less ignorant you are, the better of an investor you will become. So moving forward, so you have to ask the question, what kind of investor are you? And I think it's important to actually define this. And now this is going to sound overly simplistic, but at the end of the day, this is really what it comes down to. Do you want to be a passive investor or an active investor? What's the difference? An active investor is what you typically see on HGTV or A&E. And those are the people who are swinging the hammers or looking for the deals because they're going to buy, fix, and flip, or buy, fix, and hold a property. That part of it, that front end part of it, of actually doing the work, being in the operations side of the business, is the active part. You are not investing at that point in time because there's no cash flow. You can create chunks of cash, but there's no cash flow. So if you're an active investor, you're spending time and resources, and you're really running a business. When you start holding real estate and you have a portfolio, whether it's through syndications or single family homes or small apartments or small unit, whatever it is, when you have a portfolio of properties that are generating passive income, now you're a passive investor, and you let other people manage those properties, be it professional property managers, syndicators, or otherwise. So that's the difference between active and passive. And you have to kind of be clear on that. I kind of think about, Alice in Wonderland. Alice asked the Cheshire Cat where she ought to go. And, the Cheshire Cat says, well, where are you going to? And Alice basically says, well, I'm not sure where I'm going. And the Cheshire Cat says, well, then it really doesn't matter where you're going. You have to have direction. You have to have clarity, and you have to know where you are going between being a passive or active investor. So let me dispel one myth. There are many myths in real estate, but this is one big one that kind of bugs me. And this is one of the reasons why I rarely watch television, especially the news. There's no such thing as a national housing market or a national real estate market. And the media talks about this often as if it's this one nebulous blob that the country made up of literally over 500 metropolitan statistical areas is the housing market or the real estate market. Well, there's no such thing, because at the end of the day, all real estate is local. Every market and submarket and even if you break it down, region within a metropolitan area has its own local politics, its own local economy. It has its own local business climate. Are they business friendly, or do they have a lot of regulation like you see in many parts of California? They have their own local supply and demand dynamics. Supply, it only grows at a certain pace, and people come and go, and that's the demand side of the equation. But everything you're looking at here is all the local pieces of real estate, and therefore real estate truly is local. There are some macroeconomic factors like interest rates, but that affects everybody at the same time. But the reality is that real estate has to be treated as a local phenomenon and a local investment. Now, some people are thinking, well, I heard the gurus say that I should invest within a 1 hour driving radius of where I live, or maybe a 2 hour driving radius. And this is the whole argument of investing locally versus investing in other markets. This is actually dangerous. And a lot of the so-called gurus that are talking about this are either giving you misinformation, or what they're talking about is something that applies to the active real estate investing side of the equation, which means that you are an active real estate investor looking to buy, fix and flip, or buy, fix and hold property. So that works if you are rolling up your sleeves and actively involved in the operations or the business of real estate, as opposed to the investing in real estate. So let me just break this down really quick. So if you're investing locally, the reason people do that is, one, there's a comfort level. You're familiar with your local area and your city. Two, you're a do-it-yourself, or you're again wanting to swing a hammer, buy, fix, and flip. Three, you have a perceived amount of additional control, which is not always true. It's just for some people, they have that control because they are handyman or contractors. But if you're still working with a team, it gives you the perception of more control, especially when you can drive by and touch it, even though that doesn't change anything when you can actually touch the property. But here's the biggest thing. You don't always get the best deals. And that's the problem with being locally. For example, if you live in the heart of San Francisco, one of the most expensive markets in the country, are you really going to be getting the best deals in the country, or even in your local area? That's highly unlikely. So let's look at the flip side of that. If you're market agnostic and you're investing in other markets, you will almost always, again, depending on where you live, find better cash flow and better returns. And I'm talking both in terms of immediate cash flow, cash on cash return, and in longer term growth, what happens over the years in terms of appreciation over time. You can typically find more stable markets and stable equity growth, or predictable growth, because you can see what is going on in markets. You can do research and due diligence, which is something we do internally here for ourselves and for our clients. We track 504 markets, and that changes from year to year, but it's over 500 markets nationwide. And you can lower your risk because you can choose markets that are more stable, that have better fundamentals, that are more prone to growth. And that just plays out in your long-term success as a real estate investor, especially when you're building a portfolio that you intend to hold for a long period of time, or maybe forever. So without getting too deep in the weeds and getting too much into the economics of things, the bottom line is your local market may not, and probably is not, the best market to be investing in. Again, it depends on where you live. I mean, if you're in one of the markets that we're in, the 25 markets where we invest in ourselves, and we offer turnkey investment properties to clients, we chose those markets for very specific reasons, which is what I'm going to talk about here on the slide. But markets differ. Every market has its own market cycle. They might overlap considerably with other markets, but they have their own cycles. Markets have different drivers, in terms of population growth, in migration, out migration. They have different drivers in terms of housing supply. They have different drivers in terms of the politics and the regulations that are going on, the availability of land, how long does it take to get permits, what is the household formation, there's just a lot of things that drive a market. Every market has a different median price and a median rent, and a range of price and a range of rent within that market. Property taxes differ considerably. You compare Texas to Alabama to Illinois, and you're going to see great differences. The affordability is a driving factor in terms of where that market is headed, and the ratio of renters to homeowners in a particular market, or even in a neighborhood. And last but not least, the rent to value ratio, which I'm going to talk about on and off here throughout the next 30 minutes or so. But the rent to value ratio is just the ratio of what the rent to price is, either on a property or within a neighborhood or within a market. And this is more like a litmus test. It gives you just a quick snapshot of whether a particular real estate investment is going to generate any kind of cash on cash return for you. So we know what the problem is. You may not be in the best market, and you may not be looking at the best markets to invest in as a real estate investor. So what is the solution? Well, the solution is invest in the best markets that produce the best returns. Why is my T missing there? That is really bizarre. Okay, so that's the solution. Choose the best markets that produce the best overall returns for you as a real estate investor. So let's break this down. I like to take a top-down approach, and I'll kind of close today with a top-down approach. But I look at this as choose your market and then focus on the neighborhoods, and that's how you mitigate your risk. And then pick the properties that fit your criteria. So those are the three main components of this top-down approach. So the big picture is really the market. The market I break down into three types of markets, categorically speaking here. First is what I call cash flow markets. And now this changes from time to time, maybe not necessarily year to year, but certainly as the years go by, because markets tend to shift. And often they'll go from what is a cash flow market to becoming a growth market. So cash flow markets are the ones that produce the greatest cash on cash returns, relatively speaking, to other markets. And these factors change not just within the market, but in the sub-markets and even within the neighborhoods in a market. But again, categorically, we have three markets: cash flow markets, which generate the highest cash flows and cash on cash returns. And examples of those are, for example, Birmingham, Alabama, Huntsville, Memphis, Oklahoma City. And you'll often find these are some of the smaller markets, the smaller large markets, not the major tier one markets like LA, New York, Manhattan, San Francisco, San Jose. I mean, those markets are big markets, but also unaffordable and overpriced. You're not going to get the cash on cash returns there. Second, we have growth markets. This is the other end of the spectrum, pendulum, or the equation. But these are the markets that tend to experience the highest rates of appreciation, high growth. Now, we've seen a lot of those markets over the last 24 months, especially this year. This has been an anomaly year in terms of price appreciation across the country. But a growth market is a market that's experiencing high growth and high price appreciation for various factors, fundamental or otherwise. And what we've seen over a number of years now is hyper growth in markets such as Atlanta, Dallas, Houston, San Antonio, a lot of the southern markets, the southeast US markets. And as markets transition from one to another, or are just poised with the best of both worlds, we call them or refer to them as hybrid markets. And usually these are markets in transition, slow transition, but places like Indianapolis, the Chicago suburbs, Jacksonville, Florida, Kansas City, Missouri, the suburbs of Baltimore, southern Pennsylvania, those have been hybrid markets for a while. And so we have a lot of our clients purchasing in these particular markets. But again, this changes from year to year. Right now, there's a lot of Florida markets. We're in, I think, 5 or 7 Florida markets that are experiencing strong growth or are actually in a hybrid stage of their market cycle. So this is the big picture, the type of market. I'm not going to spend a lot of time on this slide, but there's 4 main bullet points that talk about kind of the macroeconomic factors in selecting a market. And these are the things, the major things that I look for and that we look for. Is it a stable or volatile market? Now, volatility can be your friend, especially if you're a growth investor and you're looking for high appreciation. But generally speaking, markets are either slow and smooth growing, what we often refer to as linear markets, but these are often your cash flow markets, And then more cyclical markets are the ones that are experiencing strong growth or strong decline. And those are the markets that are often hybrid or growth markets. And depending on what your investment criteria is or will become, these are the types of markets that you're going to be looking at, because you're going to choose your market first, and then you're going to focus on the neighborhoods. You want a diverse metropolitan market or area. You want diversity in the job market. You don't want to have a one-trick pony market like it's heavily dependent on, let's say, oil and gas, for example. That brings stability to the market. It offers a stable economy, and you've got jobs in all sectors, and it just creates a holistic market. So the better the diversity within that metropolitan area, the better market is typically, and it tends to weather storms a lot better. Thirdly, is you want a landlord-friendly market. That's typically at a state level. If you look at a state like Alabama, for example, which is some of the best tenant landlord laws for you as a landlord, that really helps if you have issues with tenants. Now, that doesn't happen very often, but it's certainly stacking it in your favor. And not to get political in any way, but correlation, you'll tend to find that blue states usually have the worst landlord friendliness laws, the tenant landlord laws. They're typically stacked in favor of the tenant, not you as a landlord. So just keep that in mind in the back of your head. But laws should be fair and for everybody, but it would be ideal if they favor you as a landlord. And fourth, again, the rent to value ratio, or what I just refer to as an RV ratio, or just an RP, right? Rent to price ratio. Now, this is harder to achieve today, hitting a RV or rent to value ratio of around 1%. It's still out there. It's usually in the lower priced range of properties across the country. I don't mean properties in the hood. I'm just talking about property values, relatively speaking. But you can also get rent to price or rent to value ratios that are closer to 1%. I'll explain that in a minute here. In your B- and C+ type neighborhoods, which I'm going to talk about in detail here on the next slide. But an RV ratio is simply this. You just take your monthly rent, let's call it $1,000, and divide it into the purchase price. Let's say it's a $100,000 property. So your $1,000 a month divided into $100,000 purchase price is 1%. And that's how you come up with the RV ratio. So it's a quick litmus test and easy to calculate. What ideally you want to find are properties that are as close to 1% as possible, over 0.7%, but certainly not below 0.7 or 0.6%. Because when you get down to 0.5%, you're in the coastal market of California, New York, New Jersey, you're along the western coast of the United States. That's where you find the low RV ratios of 0.4%, 0.5%. Those don't make for good cash on cash returns. In fact, it's hard to cash flow. And the other thing too is they're typically unaffordable markets. And so, you've got to draw a big question mark as to, the future price growth and the correction of those markets. Anyway, I'm not going to get too deep into the weeds. We can talk about that later. So this is an important thing here. The neighborhood types. There are essentially three, if you want to, your A, B's, and C's. Include a D if you want. That would be what I would refer to as a war zone. But let's break down the three main categories as we define them, and point out the pros and cons, if you will. All right, I'm going to start with C for a specific reason, because these are the kind of the lower price properties, and they provide kind of a frame of reference of where a lot of investors end up finding themselves in, because they're quote unquote cheaper properties. I think I'm doing good on time, but Sarah, just chime in anytime if I need to speed things up. I should be able to wrap this up by in 20 minutes, so 12:15.
Yep, perfect.
Cool. All right, so C neighborhoods are what I'll refer to as quote unquote cheaper prices. Now, again, this is relative. It's very, very much market specific. But generally speaking, and when I'm looking at the 20-25 markets that we operate in as a company, these are often properties that are under 90 to 100,000. Now I'm talking about the neighborhood level here. So if you look at the neighborhoods within many of the markets we're in, they're going to be sub $100,000 properties. These are what we'll refer to as C-class neighborhoods. They have higher rent to value ratio. So on paper, they look good. They look really good from a cash on cash perspective and a cash flow perspective. And that's not a bad thing. You know, I've purchased many properties in C-class neighborhoods, and there are many investors that I know that focus exclusively on C-class neighborhoods because they want the higher cash on cash returns. And that's all well and fine. That fits their investment criteria. That is what they have defined as their buy box, and that's what they're going after. However, many property managers will tell you there is data out there, but anecdotally speaking, they have higher turnovers and higher vacancy rates. You just have, because of the demographic, a higher turnover, more transient type of tenant. And again, it is what it is. It's neither here nor there, good or bad. It just depends on what you want. If you're looking for that higher cash flow or higher cash on cash return, this is, you know, where you should maybe look to add to your portfolio. Maybe not exclusively, but one of the biggest issues I have, and the reason why we don't offer a lot of C-class neighborhood properties, is the financing issues. Because there are not a lot of sales comparables or strong comps, you tend to have financing issues where appraisals don't come in high enough or well or strong enough. So it becomes an issue when it comes to financing. Now let's compare that to the other end of the spectrum, A-class neighborhoods. You know, this is kind of your higher end, upper middle income, not necessarily your luxury or McMansion neighborhoods, but your A-class neighborhoods. These are higher price points. And I know this $150,000 looks low for a lot of people probably listening to this because they're in some of the more expensive markets, the coastal markets. But again, this is within the context of the 25 markets or so that we are in. The single family homes, they tend to top out around 250, 300,000 in some of the larger homes in some of the nicer neighborhoods. So again, you got to keep this in perspective. But higher prices, often over 150,000, lower rent to value ratios, because as the prices go up, the rents go up too, but they don't scale at the same pace. And so your rent to value ratio starts to drop off as you go up to 150 to 200 to 225 and 250. They don't look as great on paper from a cash flow or a cash on cash perspective. So they're lower cap rates, lower cash on cash returns, but you have the lowest turnovers because you have the best quality or demographic of tenant. So lower or lowest turnovers, lowest vacancies, very few financing issues because these neighborhoods have very strong sales comparables, a lot of sales, and the comps are just very stable and consistent. These neighborhoods also tend to do very well in terms of price appreciation when a market is experiencing price appreciation. And then lastly, the B-class neighborhoods. This is what I like to call more of a hybrid type of neighborhood. It's like the hybrid markets. It's a good middle ground. And again, very much market specific, but usually around $90,000 to $150,000 in price range within the markets that we operate in. Moderate rent to value ratios. They do look good on paper. They cash flow well. They have good cash on cash returns. Relatively speaking, low turnover, low vacancy. This is your bread and butter, a lot of your bread and butter neighborhoods. These are neighborhoods that are, you know, your middle America, middle class, you know, your good school districts and whatnot. And they're still easy to finance because there are a lot of sales and sales comparables. So what is my personal qualifier? Simple. It's very simple. If there are no retail buyers in a particular area or a neighborhood, stay away. Just don't buy it because it's easy to buy real estate. It becomes hard to sell real estate because there's a lot of elements in terms of price, demand, and you just need liquidity in a particular market and neighborhood. So if you don't have retail-based buyers, not investors, but retail-based buyers in a particular area and neighborhood, then I would stay away from it because you want to know that it's an area where there's activity and growth. Now, I wasn't going to include an example, but I threw one of 4 examples in here. This is actually what was one of my properties in Kansas City, Missouri. And I only bring this up to illustrate, you know, what I was talking about. But at the time when I bought this, it was $145,000 with a rental income of $1,400 a month. So if you do the math on the rent to value ratio, it's pretty much a 1%. Today, this property, because it's appreciated so much, the rental fair amount as well, but that RV ratio has probably dropped to about 0.9%. But it's a typical 3-2 bath, 3-bedroom, 2-bath home. It's in an A- neighborhood. It was really solid buy at the time. And don't let your eyes glaze over as I bring on the other half of the screen. There's a lot of numbers there. This is actually the cash flow analysis tool that we have on our website, and it's attached to every single property, so you can actually see a detailed breakdown like this for whatever we post on the site. Quick disclaimer, it's nearly impossible for us to do anything in real time or near real time as far as inventory on our website. There's less than 10% of our available properties that are posted on our website at any given time. So it's a small splattering of what is actually in the pipeline. The sales velocity today across the country is just crazy. So we do have an inventory shortage, an inventory problem. It's fixing itself over the next few years. But just be aware that you're not going to find a lot at this time on our website. But here's what I want to point out. So when you take your income, deduct all your expenses, and you're being reasonable about this, you're actually including vacancy and maintenance and repairs to give you a true number. What you end up with is your annual and your monthly cash flow. And that's one thing you want to focus on as a real estate investor. And I'm only throwing this up just as a quick illustration, but you do want to pick your markets properly. Then you want to focus on your neighborhoods that meet your investment criteria. Again, the top-down approach: markets, neighborhoods, then properties. And then focus on properties within those areas in that market that meet your investment criteria in terms of cash flow, demographic, RV ratio, whatever it may be. You got to define your buy box. And if you need help with that, certainly talk to, whoever your mentor is, or talk to one of our investment counselors. We can help you define that. And then, you've got the equity component. You'll make an assumption as far as what your appreciation will be year over year over the long term. You want to be realistic with this. We had a crazy year in terms of price appreciation this year, pretty much everywhere across the country, but be reasonable about it. Most markets over the long term average out 4 to 6%. And there is a high correlation to the real rate of inflation that is in the country, not the nominal rate of inflation. But on top of that too, remember the two of the biggest drivers are supply and demand in a particular market. So even though your inflation rate might be 6%, you might have dynamics going on in the market where so many people are moving in, like in Florida, markets in Florida, where it's just pushing prices into double-digit price appreciation. But whatever that is, your wealth is measured in terms of your equity across all your assets. And so, you can track that, and you should track that from year to year. And then the bottom line is properties will provide you a cash on cash return. That's your, measured on your cash flows. But then when you factor in the amortization of your loan, which averages 6.66% per year on a 30-year fixed rate mortgage. I know it's a lot of numbers I'm throwing out at you, but just understand that there is a rate of return from your tenant paying off your mortgage over time. And it averages out to being over 6% per year over a 30-year period. That plus the appreciation over time on your property really makes real estate shine. It makes it one of the best. In fact, I will argue it is the best asset class and the best investment that you can make, because when you add your cash on cash return to your amortization and appreciation plus the tax benefits, you have a solid investment that generates wealth, cash flow, and provides tax benefits. And this particular property here, if you are from the internal rate of return world, the IRR world, the commercial world, has a 5-year internal rate of return of 33.6%, which is fantastic. So let's start to wind this down. Here, I want to put this on. I just put this slide on at the last minute, just as a frame of reference, because I thought it would make a good frame of reference. So our definition of a turnkey investment, which is something you can model what you're doing, regardless of where you're investing, is a property that is in a stable or growth market. Okay, you want a stable market or a growth market. You want to be in a desirable neighborhood. For me personally, I'm in B+ and A- neighborhoods. That's my focus. But anything in the B's or A's to fit most people's investment criteria. It has to be either new construction or newly renovated. In other words, you don't want deferred maintenance. You don't want to buy a lemon. You don't want to buy a property that you're going to be putting money into the day after you close on it. You want cash flow positive properties because you want the property to carry itself. The cash flow is the glue that holds your deal together. So you do need cash flow. Even if it's zero, you can weather that for a period of time, but ideally you want that to be cash flow positive or to grow into a cash flow positive property. You want it leased, obviously, or be in the process of being leased. Obviously, a lot of what we're selling today is new construction just because of the way the market has shifted towards build to rent. So if it's not leased, it will be leased. And it has to be under professional full service property management. That's the key, because if you're going to be a passive real estate investor, you don't want to be handling necessarily anything day to day, month to month. You can if you want, it's your choice, your property, but to be truly passive, you want to manage your managers and have your managers manage your properties. And of course, all properties are carefully selected and researched, and you do your due diligence with your renters in mind. Pop quiz question, you don't necessarily have to answer this, but if for yourself, just for fun, if you can identify the house in the top right corner, you probably watch too much TV, but the house in the top right corner is actually the Simpsons house on the cartoon, The Simpsons. All right, so let's wrap this up. The top-down approach. This is very generally speaking the step-by-step process that we take our clients through, our investment counselors take our clients through, and basically what, how I invest myself. Always start out with defining what your investment goals are, like clearly define them, and your criteria. Know the type of market you want to invest in, the type of neighborhood, what your cash flow needs to be per month or a range. Just the more you can define, the better. Now, if you get too finite with your goals and criteria, then you're going to have a hard time finding what you're looking for. So have some flexibility and define things in terms of ranges, but understand what your goals are. Pick the best markets and the best neighborhoods that fit your investment goals and criteria. That narrows the 500 plus markets in the United States down to something you can focus on and do your research and due diligence on, and then start looking at neighborhoods and identifying properties with your team, which is the third point. Assemble the right team. You want the right acquisitions people, whether it's a real estate broker agent, whether it's a turnkey provider like Norada Real Estate, whether it's a syndication team, regardless of what it is, you want the right team in terms of acquisition, financing, asset protection, your tax advisor, your title escrow company, et cetera, et cetera. You want to assemble the right team. And you can get these through references, referrals, people in the industry. I mean, we've already assembled all that. You get everything on a silver platter, the entire team. So it's really the spokes of the wheel that we call it. But the team is very important because these are the people who are going to be helping you achieve your goals. Choose good properties, narrow down a list, do your initial due diligence, find the ones that make your short list, then you continue doing your due diligence. Ultimately, when you've got one or two to pick, you put it under contract, you do your inspections, you verify all the numbers. Ronald Reagan said, trust but verify. Just confirm all the numbers are accurate, so your cash flow projections or pro formas or the actual cash flow P&Ls are accurate. And then finish working with your lender, mortgage provider, and then close and put that under your belt and move on to the next one. So you just rinse and repeat. And that's pretty much it. So what's next? Not to leave you guys hanging, but a lot of what I've talked about is in a 40-page primer called The Ultimate Guide to Passive Real Estate Investing. This has been downloaded probably 10 or 20,000 times off of our website. You can get a free copy of it at our website at noradarealestate.com. I'm going to be adding to this and actually creating a version 2 of this. So, but the principles and the concepts and what's in this document is actually eternal. They're principles. They're not just market specific. And if you do download this, you will be on our short list to receive a free copy of the book that's in manuscript right now that's coming out. I don't have a date, but this year. But everybody will get an email notification when the book is released. So there'll be a free downloadable copy, or you can, get the paperback for free with shipping, but it's a downloadable PDF. And so that's the full version of the free report that I was telling you about here. This is basically the expanded version of it. That I think is pretty much it. Oh, I almost forgot. I don't know how I could forget this. So I do a weekly podcast called Passive Real Estate Investing, and really it's talking about everything we've talked about here and then some, including some personal development and mindset. So And I also do a lot of Ask Marco episodes. So people submit questions all the time, and I try and cover anywhere from 3 to 5 on the Ask Marco episode. So it's kind of an open forum for people to ask questions, because I don't know what you're thinking, and just gives me an opportunity to answer somebody's question that other people are thinking about and not necessarily, letting me know about it. All right, well, Sarah, that pretty much covers it. So I think I did it in time.
Yeah, you did. That's awesome. So I think there are a lot of really, 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 really important things that you talked about just now. And one of the things that really resonated with me was the market discussion. So I'm in California, and if you want to stop doing your screen share, then we can see.
Yep.
Oh,
I was just finding the button.
Okay, cool. Yeah, so I'm in California, and people always ask, like, oh, you're in real estate, you're in California. I don't own anything in California, for the reason that you were talking about. Like, I invest for cash flow. I don't buy anything that's not cash flowing. So I'm in Texas, Georgia, Tennessee, South Carolina, because those markets fit my goals, my investing goals. So I think that's great that you have that step-by-step process of think about what your goals are, and then choose a market that can reach that goal, and then choose your property. Same process that I go through. And I also like that you highlighted focus on B properties. And that's what I do as well. And so I want to reiterate to folks on here who are looking to be passive investors that when you do get into the C's and D's, you actually become quite more active. It takes more time. So you might make a higher return, but it's going to be a lot more effort. So, and then your last point around team, and that being a key part of the process of making sure you have good property management, good tax advisor, 100% agree. That is super, super important. So, so thanks for sharing all that process. And now we can open it up. There are a few questions that were going on while you were talking, Marco. So if you'd like to address some of those, if you can see them, or I can read them out loud to you, whichever you would like.
I'm opening it up right now.
Okay.
But we can do it either way. So I assume I'm doing this right. Is it wise for older investors to begin in this if they have had prior real estate experience or training, or if they have not had prior real estate experience? I assume what you're, whoever this anonymous person is asking is if it matters what your age is in terms of investing in real estate. Well, I guess I can only answer that generically. I don't think it really matters at all, because if you've got investable cash and you're trying to ask yourself, what should I do with the investable cash that I have? You got to make a decision. You either leave it in cash and it's going to be eaten away at whatever the rate of inflation is. And we know inflation this year is very high. In fact, there's a lot of articles and whatnot coming out showing that inflation is like 15% plus, and you can see that in terms of food costs and whatever else. But regardless of what it is, whether it's 15, 10%, 5%, at the end of the day, it's inflation. It's chewing away at the purchasing power of your dollar. So the only way to stay on ahead is to beat the real rate of inflation. So what do you do with it? Do you invest in stocks, bonds, mutual funds? Do you invest in gold, silver? I mean, most of these asset classes, with the exception of the stock market, the S&P and the market as a whole, has really been underperforming, some grossly underperforming the real rate of inflation. The only reason the stock market has been running so strong for so long is it's been juiced because of all the money printing, if you will, and liquidity that's being put into the system. So how long can that go on for? I mean, there is definitely we are overdue for a stock market correction, and that will ultimately happen. Nobody knows when, but don't be surprised if you see a 10% correction. The thing is, what do you do with your investment capital? If you're, comfortable with the stock market, and I'm not in stocks, you could put it there. But real estate is a great way to hedge against inflation, also generate some passive income, some cash flow, but also position yourself for two more things: tax benefits that come out of the real estate, and secondly is the unrealized returns that you get through the appreciation over time, as well as the amortization of the loan if it's leveraged. And so having said that, it makes no difference what your age is. I mean, it doesn't matter whether you're 18, like I was when I bought my first property, or if you're 65. you're making a decision not based on age, but you're making a decision based on what is the highest and best use of your investment capital. So I'm not sure if I answered that question the way you wanted me to answer it, but that's basically what I would say.
I will add my 2 cents in that I think you need to look at, I think your age would probably influence the type of property or the type of investment or the market that you would choose. So you have older and capitalized. So, if you're 85, something that's going to appreciate and exit in 10 years is maybe not the best use of your money because you probably want to use it today. So cash flow is going to be more important to you. So I would say older isn't like you should or shouldn't invest in real estate. I would say that it will define what type of real estate you would end up investing in based on where you are in life and what your goals are.
Yeah, you're right. And that always goes back to what are your goals and
Exactly.
and what is it you're trying to achieve? Because even if the appreciation might not be important to you now, but if this is part of your trust or your estate and you plan to pass that down to your kids or your relatives or whatever, you've got to keep that in mind as well, because that's to their benefit, maybe not your benefit. So if you don't need the cash flow, then that's not as important as what the other benefits are longer term from what you're investing in.
Yes, exactly. Marco, I think the other one would be great for you. Do any properties with RV ratios less than 1% become properties which can be sold to municipalities for public use?
I don't see the connection or correlation in that. The rent to value ratio is just a quick litmus test or a metric just to give you a snapshot of what the cash flow potential of it is. So as the closer it gets to 1%, or even if it's a little bit over 1%, it'll tell you that it'll cash flow almost always. And it gives you an idea of, how strong of a cap rate or cash on cash return it'll be. So again, it's an ideal target. It's not always achievable, but, as close to 1% as possible. But I don't see how that's, tied to municipalities for public use or anything like that. I mean, they're not even looking at it that way. So anyway, I hope that answers the question.
Well, and then we have one more and then we'll jump to the next person. So this is Lorenzo. Sure. What do you think will happen when the California eviction moratorium ends in September? Will there be a rush of properties for sale? So I am in California. So I'd like to take this one and say that my home last year, I moved abroad and I put my house for rent. And then I came back and I wanted to move back into it. The lease ended. The tenants are still there. We're evicting them. We can't get them out. It is ridiculous. And it's not like it's, it's a over $2 million home. So it's not like these people are, hurting for other options in life. And they're just thinking, there's so many people in California that are just riding this situation. And it's so frustrating. And so whether or not properties will go for sale, I think there will be a shift in things. And I'm not in the single family home space. So Marco, I'd like to hear what you think. If like single family home rentals, when eviction moratorium ends, you think that'll affect the number of properties for sale? I don't think it'll have any effect on multifamily sales. But what do you think?
It's a difficult question to ask, but I don't think there's going to be a rush. I'm rereading the question. Will there be a rush of properties for sale? Now, I assume what's being asked is there going to be a bunch of properties put on the market for sale?
That's what it sounds like.
That's kind of how I'm reading that.
Mm-hmm.
I don't think there's going to be a lot, if any. First of all, right now, because demand is strong for properties and supply is short, there's like less than 2 months of inventory available for sale. Anything that's going to hit the market is going to be scooped up very quickly. And because of that supply demand dynamic, property values are being pushed up, even though they're unaffordable, but it's being pushed up. So I don't think the moratorium is going to have a major effect. There are people ready, willing, and able and to buy property that comes up for sale. And a lot of properties are being bought all cash right now too. Like that number has been increasing. So So I think it's going to be a blip on the radar. It's not going to be a major impact. There might be some, feathers ruffled and a few things, few people being transitioned from one place to another because of it. But anyway, I think it's unfair regulation. There's been a lot of overreach. It's a lot of protection for tenants and virtually no protection for the capitalists, the people that have taken the risk to put up the time, money, and effort and take the risk to buy and invest in property. So I think it'll normalize itself very quickly.
Awesome. Thanks for that. Well, Marco, we're going to switch over. We're going to jump into the next speaker. So I want to wrap it up and say thank you so much. That was a really thorough step-by-step process for a lot of the investors on here. And I love that you have the link in the chat. So I see AJ put that. So thank you, AJ. This, at least get started, at least start the thought process of step-by-step. How do I want to get into investing and jump on in if it seems right to work with Marco's team. They are fantastic. So thank you, Marco. And thank you, Sarah. We'll see you later. Thank you.
Thank you.
Mm-hmm. All right. So next up, we have Dr. Forrest Bryant. And there you go. Hi,
hey,
how
Sarah.
are you?
I'm great. How are you? Good to see you today.
Yes, great to see you today as well. So you guys, I want to introduce Dr. Forrest Bryant. He works with people to amplify their wealth. And so today, I believe you're going to talk about how to invest like a family office, right?
That's right.
Yeah. So for those of you who are not familiar with what a family office is, I'm sure you'll go through this, but it's basically he's going to share how the uber wealthy invest and how you can do the same. And so people like me, I'm guilty of investing in one thing. I only invest in real estate, and I actually only invest in apartment buildings. And so I am not diversified, but the uber wealthy, they don't just invest in one thing. And they have teams of people who work out, how you should have different allocations of different things. And so this is something that I'm interested in learning and interested in learning more about so that I can apply it to my own investment strategy. So thanks for the topic. It's a perfect one for today.
Absolutely. Well, let me just say thank you for having me. And I'm excited. We got a lot of great information to share today. And if you're good, we will, I'll share screen and we'll get rolling here.
All right, jump in. I'll close my video.
Okay. Can you, let's see, let me do this.
Perfect. It looks perfect.
Okay, great. Thank you, Sarah. Well, let me just say thank you, Sarah, for having me today. I'd also like to thank my good friend, Eddie Wilson, for the invitation to come over here. I've known Eddie probably for 5 or 6 years now. And anybody that knows Eddie is always impressed with him and what he's been able to do in a very, very short period of time. But today I'm going to be discussing some of the strategies for investing like a family office. And we'll go through what that definition is and how you can take some of those strategies and apply them to your own portfolio and to your own investment goals. Great job, by the way, Sarah and Marco, defining 2 different paths for investing today. You heard Sarah talk about investing in apartments and apartment complexes as a passive investor. You also heard Marco Santarelli talk about investing in single family homes on the active side. So both of those things are great strategies for becoming wealthy, and those will be I will reference both of those today because those are strategies that family offices do. But hopefully I'm gonna expand your thinking and pull the curtain back a little bit, and I hope you guys will be really impressed and inspired, and hopefully educated too. So just real quickly, who am I? My name's Forrest Bryant, Dr. Forrest Bryant. I'm the CEO of High Speed Alliance, which is a company we started in 2017. High Speed Alliance is a family office that serves doctors and dentists. We are an RIA, which stands for Registered Investment Advisor, which means we're in a very regulated industry. We're registered with states and with FINRA, and I'll go through that just a little bit to explain what that means. My background was in dentistry. I'm a retired dentist. I practiced dentistry for almost 20 years. was the CEO of 3 practices, which we bought one and started 2, and we built them up to a place that we were able to sell those to a private equity entity about 5 years ago. And that launched us into the family office space to learn what a family office is. And during that time, I had a lot of my friends and colleagues say, "How did you do that? And can you help me do that as well?" So that's how we launched High Speed Alliance. Little education, graduate of Auburn University and UAB Dental School. We hold or have held securities license 66365 and also insurance certifications. High Speed Alliance has a very mighty team of 7. We've got an incredibly tight team that takes care of over 120 families and also manages 8 different businesses. So I'm not to the point that Eddie is. Eddie has over 80 businesses that he manages, and I think we're really happy with our 8. And but hats off to Eddie. But I hope if you look at that, you can realize that you can probably do way more than you're capable of doing. Also, on a personal note, I'm married to my lovely wife, Carol, for 25 years and 2 kids in college, a son at Auburn and a daughter at TCU in Fort Worth. So I'm going to flip up a little disclaimer here. As I mentioned, we are a licensed investment advisor, which means we are allowed to and licensed to give investment advice. However, I will say that the information that I'm going to be sharing today is educational only. It's in a general sense. I have no idea your personal situation, your personal goals, risk tolerance, time horizon, or objectives. So anything that you hear today, please run it by your financial advisor, your CPA, your board of advisors before you make any changes to anything that has anything to do with your money and your future. Okay, so what we're gonna cover today, what is a family office, who is part of the family office. We'll go over some family office investment strategies, talk a little bit about accountability within the family office, and then roll through some takeaways and wrap ups. So first question you guys may be asking is, well, what the heck is a family office? So the best way to describe this is to give a historical example. So, imagine, during the Middle Ages, a European, very wealthy family that, may have many businesses and lots of farms and lots of real estate to manage. If that was going to be protected within the family and allowed to continue to grow and operate over multiple generations, there would have to be some structure that would be built around that. You can also fast forward into today. There are many growing family office market in Asia, and then in the U.S. From the old school, you can look at the some of the family names that you may know: John D. Rockefeller, Andrew Carnegie, J.P. Morgan. You guys are probably are familiar with those stories. How that wealth was created many generations ago, how it was maintained and continued to grow and protected over multiple generations so that those family offices still exist today. You can also look at tales like the Vanderbilts to learn how not to do it. That's an important lesson to learn as you're becoming a student of financial history. Also, I didn't put it on here, but if you are going to do some education along the Andrew Carnegie line, make sure that you look up Henry Phipps Jr. and what he was able to do with his family office. And also on the modern day, some names that most of you will know: Warren Buffett, Mark Zuckerberg, Elon Musk, Bill Gates. All of these very, very wealthy individuals have their own family offices. And some of the things that I'll talk today will reference some of the things that they are doing or exemplary of family offices. So, from a financial standpoint, typically you're looking at a family that may have somewhere between $50 million and up to $5 billion. There are some family offices that are smaller than that, of course, and then there are some that are bigger. But typically when you're looking at a family office, you're going to be looking at somewhere along that line. And so one of the things that I want to impart here right up front is many of you may be saying, well, I don't have $50 million, so this might not be applicable to me. But I want to kind of hit that right up front. And I want to say that you don't have to have $50 million to think like a family office. So I want to keep that thought in your head as we go forward. Many of the things that I'm going to share with you today are going to be very, very applicable to what you're doing right now, as you are, you may be, some of you may be very, very experienced in real estate, or you may be, you may have your own real estate company, or you may be working a full-time job and doing real estate on the side, or you may be a private lender and just dabbling over here, or you may be looking at exiting a business, and you may be looking at coming into some serious wealth. So I just want everybody that's listening today to make sure that this doesn't disqualify you. I want to change your thinking, and I hope I'll be able to do that in the next 40 minutes or so. So a family office runs the family and the finances and the investments like a business. So, many of you are business owners, I think, that are on the call today. So you have certain ways that you run your business. You have operations, you have a hierarchy, you have roles and responsibilities and accountability in there. So imagine if you could take those same types of KPIs or metrics and apply those to your family. What would that look like? And what would that look like if you applied that to your finances and to your investments as you go forward? These are the types of things that a family office does. Family office has a structure, a hierarchy, has a defined set of core values. It has a mission, has a vision, and has an IPS, which stands for investment policy statement. So, you've heard some discussion earlier today about building a portfolio of single family homes, and that may be part of your strategy. Is that enough for you to pass that on to future generations? It can be. Maybe your investment strategy is to invest into apartment complexes, and maybe that's it. As we go forward, I'm going to show you that there are a lot of other investment opportunities that are out there. And so sometimes it takes a top-down, what I call an asset allocation viewpoint, to look at it from the very tippy top and then work our way down. The family office has a formalized organization and has certain roles that can be played just like any business would. And some of the services that may be involved in the family office would be obviously investments, but also extends out further to bookkeeping and accounting, tax planning. Taxes is a very, very big part. I'm sure that's a big one for you guys. And also as we go forward with the proposed tax changes that are coming up, that's a really, 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 really big one. So make sure you guys are paying attention to that, especially as it relates to real estate. Obviously, legal representation, estate planning, insurance, operations. Many family offices do manage multiple businesses, and also concierge services. So that may look like travel arrangements, that may look like executive healthcare, that may look like executive assistant or virtual assistant services. So you can see there's a lot that goes into what a family office does that may take care of a very wealthy family. So what's the plan of a family office and who is involved there? Many of you have probably read some of the books by Simon Sinek. I always like to use that whenever we're doing anything, and I think that's important here, which is begin with why. So why does a family office exist? What is its purpose? In general, for most family offices, that's going to revolve somewhere around providing direction for a multi-generational entity to survive and thrive over many decades and lifetimes. So think about how hard it would be to create a plan and pass that on to your great grandchildren or your great grandchildren. That's going to take a lot of forethought in order to plan that out over multiple generations. But that is part of the purpose and the plan of a family office. The family office is gonna set goals. So, many of you have business goals. Some of you probably have personal goals, And some of you may have finance goals, but imagine creating the KPIs and metrics that are around those to look at, what does your net worth look like in 10 years? What does your cash flow look like in 10 years? When are you going to exit and sell your business? What type of freedom goals are you going to create for yourself and for your family? How much time do you want to work? What does that look like on an active basis? How many vacations do you want to take per year? How involved do you want to be in the multiple businesses or entities that you're in charge of? And on legacy, what does that look like for you? What legacy are you looking to create? What philanthropy or ESG are you looking to create for not only for your family, but to make the world a better place and to help out your community and those that might be less fortunate? So those are the kind of things that are typically defined, tracked, and measured inside of a family office. Family office is not typically somebody who just has a really high income, a high W-2 or a high 1099, maybe there's a pile of money there. Family offices are not typically lottery winners. Typically, some of these are multiple generation wealth, but a lot of them are first generation wealth that many times is created through a real estate empire, or is generated through taking a company public or selling multiple businesses, or in some cases that can be through investments, although that's not as common. And they're typically not lottery winners, and typically lottery winners don't play here. Where the money comes easy, it leaves easy. So just make sure that as you're taking a look at this, there's a lot of hard work that goes into this. So imagine if you had $100 million. So just imagine for a second. Hopefully that puts a big smile on a lot of your faces. What would you do? You wouldn't go down to Merrill Lynch, Bank of America, and say, "Hey guys, I got $100 million. Will you take care of this for me?" It doesn't work that way. If you had $100 million, you would actually create a business around that money in order to protect it and for it to continue to grow and for it to last for multiple generations. So what does that team look like? You may hire a CEO, you may hire a COO, you may hire a CIO, you may have a C-suite of executives that you bring to the table. You may hire your own CPA, you may have your own attorney, you may hire an investment advisor, a registered investment advisor like High Speed Alliance. You may bring in mentors or a board of advisors to help guide and direct the team after you're gone. The key to success here is really communication. And so we see this many times. You may have a lot of these people in your, if your circle of advisors or your board of advisors, you may have some of these people on your team right now, but they don't communicate together in most cases. So critical to have good communication between all of the entities here. A family office is going to schedule monthly or quarterly check-ins along with annual meetings. So this is where some of this can be a lot of fun. And this is a tip that all of you can take from here. So schedule an annual meeting with your family and talk about the family and talk about the finances and talk about the investments and start to educate your family on some of the things that you guys are learning. Talk about creating a portfolio of single family homes, or talk about private lending, or talk about investments into different types of real estate, and talk about what that looks like for future, and set goals and track those goals on a monthly and quarterly basis. And the philanthropy, or the ESG, is a really important part. ESG stands for environmental, societal, and governance. So really what that means, that's kind of like investing with the heart. So that's investing to make money or to make a return, but doing it in a way that is good for mankind or good for the community. Maybe that's, depending on what you're passionate about, that may be, surrounding, climate change, or society, or ending world hunger, or providing residences or clean water, whatever the thing is that you're passionate about, and investing in a way where you're going to create a return, but you're also doing that in a responsible way. Obviously, philanthropy would be thinking about giving away money or capital to any charity or foundation that you are passionate about. But in general, that's a big part of wealthy families coming together to think about, how do we create a vision and align that vision, not just for the Gen 1, but also Gen 2, Gen 3, Gen 4, and passing that down multiple generations to make sure that the family vision is passed along. So let's talk investment strategy just a little bit. So how are the super uber wealthy investing their money? So one thing that's really important, and this is some takeaways if you're taking notes. You got to define your goals, your short-term and your long-term goals. We talked earlier about different types of markets and different types of returns, and you can apply that on a broader sense to any investment. So that may look like creating generational wealth that's going to last for multiple generations. And how do you do that? Philanthropy, obviously. Risk tolerance is a really big one too. So, and this is one that a lot of people say it, but a lot of people don't really understand how to assess it and how that actually applies to your portfolio. So, I find that, because we work with a lot of doctors and dentists, and I'm sure many of you are the same way. Everybody wants to get rich overnight. Everybody wants to make a lot of money, and they want to make a lot of money now. And that is a big, I hate to say differentiator, because family offices still want to grow wealth, but they're very, very patient, and they're not looking to get rich overnight. They're looking to get rich over a long period of time, and to preserve that wealth and to be very patient about it. And so that's a really important piece of understanding the risk and how much risk that you should be taking. Time horizon obviously is really important. Are you looking to be an investment that's a 6-month investment, a 5-year investment, or a 20-year investment, or maybe even longer? So we have some investments that stretch out over 50 years. So, it's important to think about the time horizon and what that looks like. And then obviously tax efficiencies. There's many, many tax strategies. And those are very, very important. I'm imagining that many of you that are on the private investors that are looking to become confident investors, income tax is very important to you, but obviously taxes on business sales, real estate sales, estate, all of that will become more important as you continue to grow your wealth. One thing that's really important here as well is to set your destination. And I always like to kind of go through a few definitions for you, because many of you probably never heard this before, but where are you trying to get to? Obviously, millionaire is one of the first rings. So, obviously that's pretty easy to define, having a net worth of $1 million. Also defined as a high net worth investor. The next level up from there is an accredited investor. That was mentioned earlier. Accredited investor is a net worth of $1 million, not including your primary residence or by income. If you're a single tax filer, that's $200,000 and reasonably expect that to continue. Or if you're married, $300,000 and reasonably expect that to continue in the future. So maybe moving up from there, maybe you want to be a multimillionaire. So that may look like $2 to $5 million in net worth. The next rung would be a pentamillionaire, 5 million or greater, also called a very high net worth investor. The next level above that would be called a Deca Millionaire. So that would be a $10 million net worth or more. Many times we call that the 8-figure club. So, once you hit 8 figures, and we've been very fortunate in High Speed Alliance to walk quite a few investors across that threshold into the 8-figure club. And then above that, we've got the ultra high net worth over $30 million. And then there's several levels above that, which I won't go into today. Trusted team to locate and vet appropriate investments. So this is really important. And, all family offices have that in place. And so I would ask you, as an individual investor, how are you locating and vetting your investments? You may trust somebody to go and seek those out, or you may be a DIYer, a do-it-yourselfer. You may be trying to do this on your own. And you've heard this term multiple times today, and I'm going to say it quite a few times today, is due diligence. Due diligence is critically important, whether you're trusting somebody if you're a limited partner or a passive investor in an apartment complex, or if you are buying a single family home, or if you're doing anything in the real estate world, or if you're buying into any type of business, whether that's private or public. There has to be a system and a funnel to find these opportunities. And so that's critically important. All family offices do it, and you should look at how you are sourcing these deals in order to invest into them. This has been said today as well. Defining active, passive, or it actually gets deeper than that. You could be semi-active or active passive, and determining what that means. Not only on cash, but also on time. So, do you want to be actively involved, and do you want to spend time involved in this entity? Do you want to be passive? Do you not want to spend any time? Do you want passive income? And even to take it to another level is to look at the tax benefits. And I think I see a lot of syndicators get this wrong, where they are promoting passive tax benefits, or I'm sorry, they're promoting passive income, but they're also promoting active tax benefits. So make sure, if you're looking at investing in an apartment complex, make sure you understand the tax benefits, and those do not apply to your active income. So if you're looking for tax benefits that apply to your active income, that's not going to be through passive investing, unless you're a real estate professional, but we can talk about later. So make sure that you are looking at your different buckets of money. If you're looking at cash, if you're looking at tax deferred, if you're looking at your tax-free buckets, and what exactly you want those dollars to do. Time horizons is also, are you looking to create cash flow? Are you looking to invest into something that's going to generate cash flow now and for a long period of time? Are you looking for a big lump sum later on? You don't care about cash flow now, but you're really seeking a big lump sum later on. Are you looking for some combination? Are you looking for a little bit of cash flow along the way, and then a decent payback on the other end? And then obviously internal rate of return is one of the ways that you can measure that. So make sure that you are reviewing that as you go along and evaluating different investments. Asset allocation is critically important. And so this is one of the things that is probably one of my most important things to do with family offices and high net worth investors, is to look at all the different investment options out there. And I'll show those, I think, in a couple slides, to kind of look at some of the things that we invest in, not only using the family office strategies, but also looking at endowments. And I'll go through that a little bit, but you can kind of look at that through public versus private. We do a lot on the private side. So we do a little bit in the stock market, but most of it's private alternative types of investments. And I will show you some of those. And then obviously due diligence, for our family office and for most family offices, I used to do a lot of this for myself and for clients. We actually got to a place where I didn't have the time and the bandwidth to do that. So we brought on a chief investment officer to help, that looks through every sponsor, every deal that we look at investing in, and that we also share with our clients as well. So make sure that you become an expert in due diligence, and make sure that you're taking a really good look at that and taking that seriously. Slowing down here. Okay, so continuing on with strategy and some things that you can do as well. Invest early and often. Albert Einstein said that compounding interest was the 8th wonder of the world. So the longer you are able to put money to work, and compounding the interest or compounding the returns is going to be really critical. So if that's too late for you and you feel like you've missed the boat on that, make sure you pass that on with your next generation. That is really, really important. You have to protect the capital, and you don't have to get very high returns when you protect your capital and you allow it to compound over a very long period of time. And this is a really important one here. And so how you get wealthy is by investing into real estate and operating businesses. This is really probably the cornerstone of what I want to share with you guys today. This is what family offices do. And this is what many of you are here today to learn, how to invest into real estate, but also make sure you expand your scope to think about investing into operating businesses. This is how wealth is created, and this is how it's protected over a very long period of time. Make sure that you're getting educated. I know that's why you're here today. Make sure you're learning about tax strategies, and make sure that you're doing your due diligence and passing that along. The Warren Buffett rule number 1, don't lose money. Minimize your loss of capital. I know a lot of you may not do your due diligence, or you may jump into things because you think it's going to generate a very high rate of return in a short period of time, and you end up losing capital. This is one of the hallmarks of what we do. We always try to protect the capital. In the 4 years that we have been advising clients, we have not had a client lose a single dollar of investing capital. So that's really, really important. I'll also just real quickly, the triple D, almost every single client that comes into our comes in as a new client tells a story about losing money, and we've dubbed that. Actually, I can't take credit for this, but we've dubbed it the dumb doctor deal. So many of you, whether you're a doctor or not, may have an example of that, where there was some startup company that you invested in, or maybe it was some real estate investment and you weren't educated, you didn't do your due diligence, and you lost some capital. And so a lot of people start off and they go, well, golly, I did that and it didn't work. I'm never doing that again. You can do it, but you may not have been had the education or the due diligence piece in place. Diversification. This was said earlier, you can't invest all in real estate. It can't all be 100% in real estate. I think I'm going to have to start speeding up a little bit here. Look for family offices, look for home runs, and there's a certain time and place to do that. And we do it with critical thinking and goal setting. So, but you can do this as well. You can look at businesses that can be launched or purchased. The value can be multiplied and those businesses can be sold. We've personally done this. We've helped many of our clients do it, and many of you have the ability to do that. So an example of that may be looking at a value add real estate investment, where potentially you could buy something based off a value, and it could be rehabbed and value added to it, and it could be sold on a cap rate. So, that's an example of an arbitrage where you can buy it on one valuation and sell it on a different type of valuation. An example of arbitrage that can be applied to commercial real estate and also to businesses. Venture capital is an example of some early stage investments that can have very, very high multiples, and these types of home runs can really allow you to take advantage of the time value of money, where you have multiple home runs, and many of our clients get to a point where they may have they really conservative investments on a large percentage of the portfolio, but they're also creating some home runs on an annual basis, where you have some big chunks of capital coming in, and that can really speed things up. Also, family offices pay attention to macro trends, and I would, some of those may be electric vehicles, energy, climate investing, technology and what's happening there, finance or definance, life sciences, and even space. I'll go a little deeper on electric vehicles here, just as far as a macro trend. Listen to me here. There will come a day when internal combustion engines are not operating, or the minority on the road. We know that that's a fact. So if we know that that's a fact and we want to get ahead of the curve, how would you invest into that? So we're infrastructure investors. So what does that mean? So in the EV space, that may look at investing into lithium. That may look at investing into lithium mining. That may look like investing into battery operation. That may look like investing into electric vehicle manufacturers. So, looking at certain infrastructure investments that we can make all the way up, and when we have the wind at our back, and we know that that there's a wind, there's wind in the sails, and we know that there's not going to be some major headwinds to there. Climate, obviously, energy, understanding what's happening there, understanding what's happening in technology. Finance, space is another big one. Infrastructure, looking at private investments into certain companies like SpaceX, or certain satellite companies. So, this is an area that we look into, but make sure you're paying attention to macro trends and understanding the direction that we're going on a high level, and understanding how that affects you and your portfolio. Also, hedging strategies, as we mentioned earlier a little bit today. I've seen very, very few family offices that don't put a very high value on permanent life insurance. The super wealthy buy their life insurance, they don't rent it. So if you think about a rental property or personal residence, some of you may be renting the house that you're living in. Obviously, if you own the house that you're living in, and especially over the last few years, you've seen probably tremendous appreciation in that home. And that's how you capture that equity. And the same thing can be applied to life insurance, where the wealthy own their life insurance. And this is a big piece of maintaining that wealth and passing it on to the next generation. Obviously, we talked about real estate. We talked about a little bit about inflation going through the roof. And obviously, real estate, especially if you look at apartment complexes, if you look at industrial, self-storage, any of the other real estates, those hotels are another example where rates can be changed on a daily basis, even in order to keep up with inflation. Operating businesses, one of the family offices that we work very closely with likes to invest into two businesses. They are dental practices, no surprise there, really great place to invest. And the other one is funeral homes. I don't have to go too deep there. You can probably understand why they like investing into funeral homes, because that's a very solid business, and the macro trend is going to take care of itself. Precious metals is also a way to hedge in the craziness of the world, the money printing, the devaluation of the US dollar. And also, if you just look at, if you look at long-term secular trends, if you look at, the value of gold, in 1971, in the early 70s, $35 per ounce. And then today, you're bouncing around $1,800 an ounce. So, and I can pretty much, my belief is that, if we go forward another decade or two, those prices are going to be up multiples of where they are today. Life settlements also is probably an investment that maybe you guys have never heard of. It's kind of the back end of the life insurance industry, where you can actually own fractional entities in life settlements. And we like this place, and I'll show you on the next slide. The endowment industry is one of the largest investors in the life settlement space. And that is because it has bond-like risk, meaning it's very, very low risk, also has a very, very high return. And so family offices are very patient, and they're looking for low risk, high return investments. So let me go through this quickly. And I'm sorry, I'm going to start, I'm speeding it up here a little bit. Wanted to spend a little bit of time on this slide. I'll try to make it pretty quick, but this is an example. This is the actual allocation of the Yale Endowment Fund, which has crushed all other Ivy League endowments over the last 20 years. So down here at the bottom, we've got from 1990 to 2020. And I'll run through these just so you can see this top level. And so what I want you to appreciate here is the top is leveraged buyouts. So this is very, very small here, and it's much larger now. So just if you can appreciate the trend. The next one is venture capital, which you can see the trend is up. Natural resources, which you can see the trend here. Real estate is in the orange. Absolute return. So I'm going to spend a few seconds here talking about absolute return. Absolute return is life settlements, and this is one of the largest allocations in the Yale Endowment Fund. So basically, what an absolute return means is that you know exactly what the return is going to be. You just don't know what the time frame is going to be. And family offices love absolute return investments. The red line here is a foreign equity. The blue line, which should surprise you, is domestic equity. So this is U.S. publicly traded stocks. And if you see back at 1990, it was about 45% of the portfolio. And today it's less than 5%. It's about 2.5% of the Yale endowment. That should be surprising. And down on the bottom, we've got cash and fixed return, or I'm sorry, cash and fixed income. So this would be cash and bonds at the bottom. So I want to pause here. I know we're getting short on time, but I want to point out two things. The two largest allocations for the Yale Endowment Fund are venture capital, which is purple here, and absolute returns, which is life settlement. So I can't see you guys. I know you can see me right now, but if I asked you guys, if we were in a big room of 1,000 people, and I asked those of you that have an allocation to venture capital and to life settlements to raise your hand. I would dare say that there's probably not anybody that's on the call today that has an allocation to both of those. There might be a few of you, which might surprise me, but this is hopefully this will underline some things that endowments and family offices have access to, some things that most Main Street investors don't have access to. We do for our clients, we are able to add opportunities for venture capital and for absolute return. We do have an absolute return that you don't have to be a client of HSA to invest in. And if you follow the links at the end of the prezo here, we can share that out. Just put something in there about tell me more about life settlements or absolute return. We'd be glad to send you some more information on that. So let's see, moving on here. Accountability. These are some things that family offices do and that you can as well. Schedule family office meetings. And so, you know, this can be really fun. Think about a family office vacation where you're going to take your family and you're going to go somewhere. It could be multiple generation, and you have an annual meeting where you may take everybody on a really great. Maybe you take them to a dude ranch, or maybe you go on a cruise, or maybe you just have get a suite or a conference room in a local hotel and spend some time with your family and do something fun. And then, you know, from that standpoint, you can start scheduling quarterly meetings after that as you start to develop out some of this. Obviously, offsite is recommended, and start thinking about how could you run your family and your life like a business by setting some of the goals that we talked about earlier. Creating and maintaining a plan for your wealth. So we call it a VFO dashboard. VFO stands for Virtual Family Office. So that looks like creating a dashboard, and then also having supporting information that will be a charter document or a document that you can pass on to the next generation. It's a living document that is reviewed routinely. So you could consider it a flight plan for the future of your family and your future heirs, and it tracks your activity and your goals. So you can coordinate all your stakeholders and hold them accountable. Some common mistakes that we see in the family office, which we also see with our new clients coming in, and which many of you may have made in the past, throwing darts with your investments. That means not having a plan, not having an investment policy statement, just being reactive to investment opportunities that show up to you, and you say, that sounds good, boom, throw a dart. Oh yeah, that sounds good, throw a dart over there. So you want to be more proactive and not reactive to investments. Not engaging with the professional or club and thinking about this. Some of you may be do-it-yourselfers and trying to figure out this. You know, that can be a big pothole to step into, and you know, there are a lot of mistakes that you can learn along the way on your own, or you can learn from others' mistakes and try to avoid those. Using someone else's strategy as your own. A lot of you get information from others that maybe are doing better than you, or maybe not, and using their strategies your own is sometimes a really big mistake. Not diversifying your portfolio. You know, some of you may be in the public markets only, or you may be in apartment complexes only, or you may be in private lending only. You know, we look at, you know, not only in the real estate market, but, you know, our clients are diversified into industrial and self-storage, which are two of my favorites, medical office buildings, affordable housing, apartments, and single family, of course, as well, doing the debt and the equity side. And, you know, just a quick note here, industrial and self-storage are two of my very, very favorites right now. And they're also two of the family office favorites. Shiny object syndrome, just not having once again, being very reactive and looking all over the place. And you can have what's called diversification, which can be not staying on target and just being reactive and throwing darts and getting too diversified, and that can be a mistake. Not performing your education or due diligence, and we always say being an educated investor is a safe investor. Sorry, I'm going kind of fast here. I'm trying to wrap up here, Sarah. So some takeaways. You don't have to have $50 million to change your thinking. And hopefully some of the things that I shared with you guys today will have you opening your mind. You only have to get rich once. So we say this for a lot of our clients that are selling a business. Getting rich twice means that you lost it the first time and you had to regain it. So be very, if you guys have had an exit, if you've had a home run, make sure you're protecting that money and make sure that you don't lose it, don't lose that capital, and be very patient. Don't lose the money, understand the risks and different types of investments. Do your due diligence. Don't be a DIYer. Surround yourself with like-minded investors. When I was in dental school, I had one of my patients who was very wise, told me that there's 3 ways to get rich. You guys ready? He said, you can marry it, you can inherit it, or you can spend less than you make. So I agree with all of those in a certain form and fashion, but you also have to make sure that you're doing your due diligence and becoming a wise investor, reducing taxes, and having a patient mindset. So be careful where you get your advice. Also be careful if someone doesn't have your net worth or below. Make sure you're taking your advice from those that are ahead of you. Be very patient. Remember the tortoise and the hare. You don't have to get there fast. You just have to get there and make a plan and connect with those that are already there. Okay, so thank you guys so very much. We have our giveaway for this event. For those of you that are on here, we have a family office worksheet that'll walk you through some of the steps some of the questions that I asked you today to have you start thinking about how do you set goals for your family? How do you create your own freedom? How do you create your own legacy? Some next steps for your business. So if you guys would like a copy of that, you can go to webinar.highspeedalliance.com. And you can download that. And then obviously our website is highspeedalliance.com. So if you would like to connect with us there, we would certainly love to have you come through and connect with us there. And thank you, Sarah, for having me. I think I may have gone over a minute or two, but I tried to go super fast there. This obviously I could do this for the next 2 days, and but I know I'm in a very short time frame here. So thank you for having me. I'll stop there. We can drop that in the chat box. Are there any questions? If you have any that you want me to answer, just fire them away.
Yeah, I looked through the questions, so I can kind of summarize. So thank you very much for that. And then I'll say, Ivan, if you're Ivan, I see you in the audience. So I tried to promote you to panelist. You're up next. So accept that. So we can do Q&A until Ivan jumps in. So kind of the summary of what a lot of people were asking. So your family office is for dentists, or is it like anyone can participate in your family office?
So that's a great question. We are designed to take care of doctors and dentists. Typically, our typical clients typically have a net worth somewhere between $2 and $20 million. Mm-hmm. We frequently get questions from other business owners that say, hey, I love what you're doing. Can I jump into what you're doing? And so I will say that it's not exclusive to doctors and dentists, but that's our core focus. Now, we do have a small handful of other business owners, especially if they're very, very high income, or if they have been through an exit, or if they're getting ready to sell a business. We have attorneys, or I'm sorry, we have clients that are also attorneys or business owners or very, very high income W-2s or 1099. So you don't have to be a doctor or dentist, but certainly have to be, very high income for it to make sense. But we're happy to, help and provide value, and hopefully, our share today was very helpful. And we do have some investment opportunities, as I mentioned earlier, especially like that the life settlement investment that's available, that you don't have to be a client to take advantage of that.
Yeah, I saw a lot of people interested in that. So thank you for sharing that. Some of I'm going to try to kind of summarize, because it's a lot of similar type questions. Do you have to, like, if people want to set up a family office kind of the way you suggested, the question is, do they need to set up an LLC, or can they just be a family office with their stuff kind of everywhere?
Yeah, that's a great question. And that's one a lot of our clients have up front. A lot of times, and this is a good, I think a good learning lesson for anything that you guys are going to learn over the next 2 days is, and I'll call this paralysis by analysis. It does, a family office doesn't necessarily start with setting up an LLC and doing that. And so a lot of the things that you guys are going to learn today is going to involve education and not getting paralyzed by what type of LLC, or is this a C Corp or an S Corp, or what, what do I need to do there? The main thing is, getting, all of the questions that I asked today, hopefully that was thought stimulating, and you can kind of start gathering some of those questions and deciding exactly what you want to do, and start thinking about your investments and how you want to engage your family and start having some conversations with your family. There's a lot of steps that you can do before you get to what does that look like. But yes, at some point down the road, there is a very specific family office structure that I won't get into today because it's super complex and can involve. I mean, there's a lot of different attorneys that work in this space who set up different types of holding companies and dynasty trusts, and that can get really complex. But don't get hung up on that in the legal structure as far as what that looks like. Just start to make steps for thinking about your family, thinking about your wealth, thinking about long term, and thinking about your legacy.
Awesome, thank you for that. And then the last thing that I see a lot of questions about are the life settlements. What is the link? How do they get more info on that? You mentioned it, but do you want to say it again?
Yeah, I tell you what, if you're interested in that, just go straight to highspeedalliance.com and just drop a note in there that, hey, I'm interested in the life settlement investment. Please, please send me some info on that. I'd be glad to do that.
All right, beautiful. And then I see other questions on how do we kind of learn more or do more. I think you guys thank you for that, Sherry, going to highspeedalliance.com or going to the webinar.highspeedalliance.com. When you guys go through that process, that's the way that you get in touch. And then, then you can kind of follow what information Dr. Forrest is sending out and all that. So that would be perfect. Yeah, thank you it's in the chat now, everybody. Sherry, who works with Forrest, put it in the chat. Okay, well, beautiful. That was really great for me to hear because I am in the category of, like I said, not being diversified. And so I'm excited to go to your link and download it and take a look at, hey, how should I be diversifying for my family? And since those are not my areas of specialties, how do I'm not going to be a DIY investor in those other categories. So like you said, like what team members or what people do I need to follow in order to make sure I'm surrounded by the right team to help me make those decisions? I can make decisions in real estate, not the other areas. So I think that was a really key point. And also Marco made that point, like really pay attention to who you're listening to, make sure they're ahead of you and how your interests are aligned, is it in their best interest for you to take this action or who you're following is super important. So thank you for that.
Yeah, absolutely. We obviously work with a lot of different syndicators in a lot of different areas, and we've had multiple who've said that same exact thing. That they were just saying, they're really focused on one area, like apartments. This is it. This is this is the thing. This is how I generate wealth. And then when they see some of the other things, they're like, oh man. And that's one thing that I love about our community. And Marco Santarelli is one of our guys that's very involved in I'll give him a plug. He helped us, going back to understanding the cycle, not only the real estate cycle, but also the business cycle. So, personally, we've been divesting and we've been selling a lot of, we had a portfolio of single family homes, and understanding the cycle, we've been selling. So Marco and Narada has been helpful for us, not only personally, but also for our clients in selling properties now. So, if you're looking to buy, make sure you're paying attention to what that he's saying about, now's it can be a very difficult time to buy. So, but it's a great time to sell. So, we've taken advantage of that by understanding the timing in the markets. And, seeing all of the different things. We've had a lot of syndicators that take advantage of being in our community, and they say, wow, I'm going to invest in some precious metals and I want to do some venture capital. And apartment investors say, oh, I want some industrial real estate and I want some self-storage. And, I love to see that because everybody starts growing together. So thank you.
Yeah, and I 100% believe that everyone should be diversified. So even when I talk to my investors and they're like, I love this model, I'm going all in on your investments. And I'm like, well, I appreciate that. However, I do think diversifying your investments is extremely, extremely important. So thank you for that, Forrest. I appreciate your time. I appreciate your wisdom and the links. And with that, I will say thank you.
Thank you, Sarah. Appreciate you having me. And thanks to you guys that are watching today. Good luck. God bless.
Awesome. All right, up next is Ivan. So Ivan, you can turn on there you are. Beautiful, good to see you. Hey, you match your picture in the background, your shirt and your
yeah, right. Like this is the real thing, So, some people tell me, oh, I thought that was a background. No, this is my home.
Beautiful. All right, everybody. So we have Ivan Ants up next. And Ivan and I met through a mastermind that we're both part of. And we talked about his business model for one of his companies. And it's all about philanthropic investing. And so this is really important. All the speakers talked about, like, start with your dream or your goals and then work from there. And so I think it's interesting if when you're thinking about your goals, if you have a philanthropic side to your goals, then listening to what Ivan's going to talk about and how he's going to talk, it's important to know that about yourself. Like, I'm going to be in a summit next week and it's all about investing in things that are good for the environment. So is that important to you? Or is it more important, really thinking about what is important to you, and if philanthropy is really important to you, then seeking out folks like Ivan and his companies and really exploring, okay, they have the right kind of mindset. Do the returns look like what I need for my lifestyle as well? So I'll say, Ivan, welcome. Thank you for being here.
Thank you, Sarah. It is a pleasure to be with you. And I want to say that it has been always a great relation together. You have been a philanthropy investor ambassador with us and has already bring us philanthropy investors to our companies under my family office. And it's a pleasure to be together with you and the possibilities. And I will explain more in detail, Sarah, because the concept that was for me like around 10 years ago, a revelation, kind of, I call it a God revelation, was philanthropy investing. And that's my brand. And so there is the philanthropy, right? Which is putting your time or your money in order to improve humanity, but you don't see any financial return. You just see the improvement of the planet, right? And then you have the investment side, which is when you put your time or your money to get the financial return. So I will explain more deeply after I show my video, and it goes really, really well with what Dr. Forrest Bryant was talking, which I am blown away. Thank you, Doc, because I am expanding my own family office, and you will see now. But I will show you that a short video now, so you can see a little bit more what I do, etc. And then we will go deeply, start into kind of a conversation type of a style, and I will be sharing you the story on how philanthropy investors came about, where we are, why it is an Inc. 500, Inc. 100 company now, and the fastest growing companies in the US, and so on. Okay, so if you allow me to share my screen.
You should be able to, and I'll stop my video.
Okay.
Ivan Ans is an Inc. 500 serial entrepreneur who has enjoyed not 1, but 2 years in the Inc. 500, now listed as 83rd of the fastest growing companies in the Inc. 500 and headed for a 3rd year. He's the founder and CEO of Capitan's Family Office, which comprise 3 strong divisions business development, investments, and philanthropy. The business division is directed by the CEO and business strategist, Mr. Art Marin, with more than 50 years of experience ensuring Ivan's vision becomes a reality for the world. Their mission is developing and maturing businesses that have the potential to prosper and with all the important factors of enhancing the condition of humanity. His Toyota dealerships rank as the #1 car dealership network in his state in Argentina, and expands Realty, the international real estate brokerage firm of the family office, is ensuring agents grow above and beyond financially and in their lives. Well known as the creator of the philanthro-investor brand identity, along with his books, Ivan is constantly seeking to engage others towards the improvement of the world's most major social maladies. Housing problems, successfully addressed using housing philanthro-investing by Equity and Help Inc., and now with its new startup, Equity and Help Ventures, opening the doors to the institutional investor to enjoy what individual investors have been experiencing for the past 7 years. Serious water conditions and scarcity are being addressed by water philanthro-investing with Origin Clear, the water company for the new economy, and targeted to arrive in NASDAQ in 2022. Philanthro-investor, golfer, and music lover, and having never met a person he did not love, Mr. Ivan Ans.
Okay, so Sarah, basically, this is the story on how everything arrived. I started when I was 7 years old, creating my own first company down in Argentina, and I was going through a lot of different creation of businesses. And my first company was renting my go-kart. So I will take my go-kart and rent it to kids in the neighbor. And then what happened there, Sarah, is that what happened there is that as soon as you go and grow in the expansion of the company, I start going little by little in the creation of multiple organizations. And then I arrived to a point where I had 4 different CEOs in Argentina. And this is a point that I want to make, because I came to the spot of being a founder versus a CEO. So I needed to learn that kind of in the hard way, because now I am the founder, I am the entrepreneur, and being the entrepreneur, what it does is it creates the space for you to create in different things, and it pushes you to go to the investment world, right? So the only thing that I had was the ability to go behind the computer and just being looking at numbers go up and down in the screen, up and down in the screen. And as the numbers go up and down in the screen, I was feeling like empty, because I was feeling that from the entrepreneur world, I switched to the person being behind the computer. So I was looking for, I say, how is possible? This is not for sure, it's not fulfilling as it is the entrepreneur life.
Mm-hmm.
So I was losing fulfillment as I was investing. And then one day I start my first private neighborhood. And when I start my first private neighborhood, I go and I say, well, I am now selling lots for money, trading real estate for money, like developing a private neighborhood. And one day, Sarah, there is this family in my car, Mr. Andres, and he's looking at the neighbor, at the development, and he says, Ivan, I would love to own this lot. I would really, really love to own the lot here, but I don't know if I can afford it. And the kids in the back start saying, Daddy, 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 I really want to live here. Daddy, 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 I want to live here. And so I say, Andres, I come out of the car with him, and he says, Ivan, I cannot afford it. And I say, well, can you go and get a loan in the bank? And he says, no, I don't qualify for a loan in the bank. And then I say, well, can you give me 50% of it? And then I finance you. No, I don't have the money. I live paycheck to paycheck. Well, you say, I don't have any other option for you. So I go and I am taking a shower that same night. You know how the shower, we normally get great ideas. Exactly. And I was like that. And then this God revelation comes to me. And it says philanthro investing. And I say, what are you trying to tell me? And he says, Ivan, there is a trend in the world that many years, year after year, there is more nonprofits coming on, right? And the people is raising the conscious level of help in the investment world for the humanity. And that's what's happening. And 20 years from now, it will not be so many people dropping money out of casinos and throwing money away without the due diligence, as Mr. Forrest said very well, right? Like without the proper knowing what your money is doing, and people will become more interested in knowing that the money is creating great effects for the planet and not just making rich for themselves. And that's kind of the new conscious level that the world is going. So he tells me, invest with the purpose. And so I call the guy next morning and I say, Andres, I have an idea. How much you can pay per month? And he says, well, maybe $300 a month. And I say, well, congratulations, the lot is yours. And then he says, how, why, how? Well, all that you need to do is you need to come to the lot on Saturday with your family, and we will do something special there, and I will bring the land contract with me, and you will own the lot. So he don't understand anything. He comes with his family on Saturday, and then I tell him, okay, you need to plant the tree with all your family in this lot, and you need to cut the green ribbon between two torches that we will plant here, and then the lot will be yours. You sign here, you will pay $300 a month for the next 15 years. So I add an interest rate and etc. And then he is going 100% owning the lot without down payment. So then I am sitting with my wife, and my wife says, Ivan, but this idea of philanthropy investing, it should be amazing if we bring it to the US. And then and I say, why, Bella? And then she says, well, because everything that happened in the US, then the world will copy. Anything that happened in the US, the good and the bad. And you know what I say, Sarah? I say, I don't think you're right, Bella. You know why? Because in the US, everybody owns their home. Every single person lives the American dream.
But that's not true.
And that's what I was thinking, like from Latin America, I see the US like to the top, and I say, well, you know, the US is the #1 real estate industry in the planet. Everybody owns their home. So then I say, well, but I will do my research. And I start coming to the US in 2010 and going to real estate seminars, real estate trainings, business trainings, and so on. And I discover that 51% of Americans do not own their own home. And that 51% of Americans do not qualify for a traditional mortgage. And I start researching, and I go for the highest ranking rates of home ownership countries. And then I found the US in the number 43 of the countries with the rate of home ownership.
And some is by choice, and some is by not being able to qualify and they want to. So yeah, there is a trend for sure of people not wanting to own their home. They want to have the mobility of renting. But I like the market that you serve, which are the people who do want to own their home.
Yes, and as Mr. Dr. Forrest Bryant said, these families, when they own their home, they are creating equity for themselves, right? And another thing that I discover is that when you have the ability to have a stable place and a stable point, I start realizing are digging more and more, and I start going more and more into the what are the effects of the instability of space, right? For kids, for example. So you have a kid, right, and you move the kid around, and he has kids, he has friends, friends, and then all of a sudden, the kids lose their friends. You know, they lose the stable point. There is this data that I learned, which is that if you want to develop power or grow as a family, right, or as an individual, you need to have a stable position and a stable point and be stable in that to produce the power. Like if you are switching jobs, if you are switching business, if you are switching spaces, if you are switching cities all the time, the being or the entity or the family is more difficult that will develop the power. So, and it's instability and so on, and it comes with a lot of effects that come after that. So that was my discovery. So I come to the US, and then that's how in 2014, I launched my first housing philanthropy investing project, which comes to be the Equity and Help Inc., which was shown in the video. And just in a nutshell, it positions, this is another concept, Sarah, which is really, really cool. I was also in a viewpoint that I want to pass to you. And the viewpoint was this. I was trying to invest, and I was being told passive income equals financial freedom. Passive income equals financial freedom. And then I start looking more and more. And I research what the word freedom means. Financial, of course, is finances, right? And then I research, and freedom, it is attached to being involved, to being engaged, to having a purpose, to have fulfillment to what you are doing. It's like, let's go for the freedom, right? The Constitution of America, right? Let's win this war so we can have the freedom. Let's leave the Constitution so we can have the freedom. It's about doing things and being involved and getting engagement, emotional engagement. So when I find out about that, I say, wait a minute, but the freedom itself, it comes from, it's not connected to being sitting in a beach and not doing nothing. That was one of my realizations. It's not just, okay, I sit in the beach and I receive checks every month. That's not freedom, right? So I say, okay, what is true financial freedom? And this is what my book is all about, that it will be launching next year, is having a purpose, right? And not only capital growth and cash flow, but also having a purpose and being engaged and being emotionally engaged. And so with that said, imagine if you are receiving cash flow and capital growth, but you are also getting fulfilling, and you are creating a purpose for the next 10 years, and you are being engaged. And what about if you can be the CEO of your philanthropy investing portfolio, and you can make decisions because you learn and you feel how you are helping people? So all of that concept is around philanthropy investing, which is be the CEO of your portfolio. Because this is another thing that I found out, and I am sure Dr. Forrest will be also aligned with this for what he says, is that if you just pass the responsibility to someone else and you just throw your money and say, hey, here it is, $10 million just invested, right? Here is the problem, is that responsibility is contrary to the, low responsibility, right? It gives low happiness. So if you then give someone the money and someone loses the money and you are not engaged at all, and you don't get knowledge, and you are not alert of your environment, which is connected to the word freedom also, but then you just pass the money, right? And then someone loses the money, and then you just blame that person. Now that's low responsibility. Now that's low happiness. High level of happiness comes with high level of responsibility. So this is a concept that I want to show, and that's being a philanthropy investor, Sarah, And I have two short videos to show you how that is happening in the real world with housing philanthropy investing itself, if you allow me to share a screen.
Yeah, definitely. And before you kick that off, I'll let people know. I think this model is really cool because the returns are good for the investor and the outcome is great for the, I'm not sure how you're, they're not tenants.
The family. No,
family.
we call them families.
Yeah,
We call them families.
And so I think the model is really cool because it provides opportunities of, like you said, stability and growth for those who want it, or they might not otherwise have had that ability. And also it is actually still a great return for investors, and it's predictable and stable. And so that's why I think it fits right into the topic that we're talking about today, confident investing. I think with your company, people can be confident about what their return schedule are going to look like, and they can be confident that, like you said, they're engaging, they're responsible in helping other people while investing. And so I think it's a beautiful model you've created.
Thank you, Sarah. Yes, and you and Eddie both have been great ambassadors for philanthropy investing. You bring in some of your people and your clients to us, and then Eddie has been amazing since day number one. He fell in love with philanthropy investing. He put my CEO in for Equity and Health Ventures, which is the new startup that we are creating for institutional investors that is launching next year. Also, he put Miles in the Money show, edited, and was amazing experience. And then he broadcast me in the cover of Think Realty in January with all the philanthropy investing stories. So I really want to thank you both really much for supporting my cause.
Beautiful. All right, I'll close down my video and let you share your video.
Yes, of course. So here we go.
Would you be interested in helping families while making a cash flow of 8 to 12%? Here's how. In 1940, the average cost to own a home in America was about $3,000. That's $30,000 in today's dollars. And from the 1940s to the 1970s, as mortgage prices rose, so did wages, growing 90% in those years. But since the 1970s, average wages have risen just 12%, meaning that the cost of living has been rising faster than income for 40 years. As a result, homeownership rates have decreased. Today, the majority of Americans will never own their own home. What was once middle class is now the working poor, paying their bills on time, but barely making ends meet and sacrificing other needs such as medical care and a better education just to pay exorbitant rental prices. For nearly half of Americans, almost half of their income goes to rent. But there are others in the United States and other countries with the means to invest. Many would like to see their investments make a difference while making them significant cash flow. With the Philanthro Investor Program, it's possible. As a unique Philanthro investment system, we use industry secrets to allow investors to buy a large amount of properties in a way that also secures and protects investors' assets. Here's how it works. 1. We select, research, and purchase the best foreclosed homes across the U.S. 2. You buy a minimum of 3 of these homes for 45% below after repair value, about $120,000, and pay us $15 a month to manage these vacant properties. 3. At our own expense, we do the minimum basic repairs and put the home on the market. 4. We then find and qualify families who want to buy the homes from you on owner financing for more than you bought it for. These families will improve the homes themselves while paying tax and insurance and all maintenance costs. 5. We manage the relationship with the family for you for an additional $45 per month. 6. Families pay a $1,000 to $2,000 down payment to you, and you finance them the balance with a 12% interest rate for an average of 20 years. This is how you as an investor receive an 8 to 12% return on your investment. 7. You recover your investment in 5 to 6 years while still owning your asset. This asset will give you a reliable double-digit return, and you get to enjoy your life free of real estate headaches. One of the many advantages of our system is that through the use of these industry secrets, you have anonymity and a buffer between you as the investor and the home buyers. This is how your investment will change communities all across the country. You help children. Children of homeowners statistically perform better in school and have lower drug use and crime rates. You help communities. Homeowners invest more in their local community, volunteer more, and report a greater sense of self-control and self-worth. You make a difference, and you make money while doing it. Are you looking to make a difference while also gaining reliable cash flow, financial freedom, retirement income, and something you can leave to future generations? Speak to a Philanthro Investor consultant today. It's that easy to improve your life while improving the lives of children, families, and communities with Equity and Help, Inc. Would you be interested?
Okay, Sarah. So one of the main things that I want to highlight in the system, how it works in the program. We are launching a new video, so that's a little old. But one of the important things here is that where is the philanthropic side to this? And that's what I want to go a little deeply. The philanthro investor comes, we will show him with the philanthro investor consultant. We have right now 30 employees in the Bank of America Tower in the Tampa Bay area. My CEO there, Mr. Jaime Gomez, is amazing with an MBA in the Phoenix, Arizona University and so on. So he's running all the C-suite there, and that team is managing right now the relations to let around investors from around 14 countries. 14 countries right now be philanthro investors from the comfort of their home and make the key decisions by getting all the knowledge and getting informed. So the philanthro investor consultant will get with the philanthro investor once a month, will say, this is what happened with your portfolio this month. What do you want to do with this family? This family is paying late. You want to do an extension and so on. So the philanthropic part of all of these, and the total is around $46 million that assets that have been recovered from auction houses and banks. But what is the philanthropic side? First of all, let's say that the philanthro investor purchases a house for, I will say, just roughly around 55,000, right? To just round the numbers. And the ARV of the house, the after repair value, will be 100,000. Instead of the philanthro investor coming and investing another 5,000 himself or 10,000 to improve the home and so on and sell it for 100,000, no, what we say is we team up. The company, Equity and Help, already did a prehab of the home and improve the condition of the asset before we sell it to the philanthro investor. And then the philanthro investor already bought the prehab home. And then this home now is shown to these families that come to us. And then I will show you now the videos, it's amazing. And they actually start improving the home. We sell the home for around 20% more. So if the investor bought it for 55, we sell it to the family for 65. And here is the philanthropy part. The family accesses the home with 35,000 equity in day number one. They put $1,000, they get 35,000 equity. Philanthro investing. No philanthropy, no investing, philanthro investing. That's the concept. And then, for example, if the family, let's say that the family didn't catch up on payments, right? They are 3 months late. The investor can say, hey, I am going to do philanthropy. He can say, I am going to give the 3 payments because I understand that you are a good family. You've been paying for 3 years, but you had a life situation. I'm going to give the 3 payments. I am going to do an extension of that 3 months towards the end of the loan. I am going to do, anything that the philanthro investor wants to do. And if the philanthro investor cannot afford that, then we have a philanthropic fund. And that philanthropic fund will come and will say, Mr. Family A, here is the money for your 3 payments you are late. You will pay me back in 15 months with 0% interest. So no interest, full philanthropic for the families that are late up to 90 days. If the philanthro investor cannot really afford, to do philanthropy with the family and so on. So now with that said, do you have any comment for me before I show the next 2 short videos?
I think you're good.
Okay, so let me share. This is very nice what I like to share because it will give you the reality of what is happening. I will show you first the experience of the philanthropy investor, and then I will show you the experience of the family. Each of the videos are 1.5 minutes. Okay. Give me a second. Let me see if I can share the screen here.
My name is Kim Bellotti, and I am basically an entrepreneur. Done a little tiny bit of real estate, and it really is how to get the right numbers. The object is to make sure you're not going to lose money. And so the fret over that, it kind of freezes you into really moving forward. I'm just telling anybody who might be thinking about investing with this company, you can pick the amount of money that you want to give it over to the company. They will sit down with you. They'll let you see the houses. You can pick whatever you want. That report comes to me in the email. The check is going to be in the mail a couple of days later. I get the check in the mail and I go, oh, there's another check in the mail. Great. I get a little bit excited about the families in the homes because my girl in Equity and Help that markets my houses for me, she sends me the photos. Like if I have a family that never would have been able to buy a house otherwise, is moving into one of my houses, they're fixing it up, they're sending her photos. We just put these bushes in the backyard. Look at the roses. We painted new flooring, and she forwards that all to me. So I get to see the happiness of all of that. So the purpose of Equity and Help from me is to make everybody win, from the company to the investor to the family moving into the house to the property even. I mean, it's just every aspect, there's some improvement, and it's fair across all of them. It's like there's a nice profit for the company, there's a nice profit for me, there's a good home for the person moving in. They will have a great investment, you know. In the future, the equity of the house will go up for them. It's just across the boards, it just works for everybody. Nobody loses.
So that's an experience from a philanthropy investor, and I will show you now an experience from a family. So you can see Sarah, and let me see if I have it here. Okay.
While you're doing that, Ivan, Arte, I know you're on here. There's some questions about where can people learn more, that sort of thing. If you want to post some of the links to your website or how to get.
Oh, yes. That's great. So if you like, one of the things that I would like to do is Miss Bendy Rios, which is my VP of expansion. She has been working for 10 years with me in different projects. She's the VP of expansion for philanthropy investors. She's in the chat right now. So Bendy, you can go ahead and start asking questions and give your contact data, your phone, your email, everything, so people can contact you directly. And she has a process towards your philanthropy investor onboarding and so on. Our website is pi.today. You can see everything about philanthropy investors there, and then equityandhelp.com for housing philanthropy investors specifically. Because after I show this video, I will share with you a little bit more of the expansion of the philanthropy investor brand and how to fix other areas in the planet, not only housing. So let me share this video with you now. Okay, here I have it.
We've been here for
almost
3 years now.
3 years.
3 years?
Yeah,
Yeah,
3 years.
3 years. And it's home. It feels like home. This is home. And we still, and the most fun part is we still got stuff with things that we want to do. Be more creative. Turn this into that, move this around, We live all around. South Boston, Virginia, and then Philly. It feels good to be able to call your house a home. You know what I mean? And it's a difference. It's a very big difference to be able to paint a wall green if you like, or paint a wall brown or tan or whatever, which I have a lot of colors going on. So I work for families, taking care of their loved ones. And Harry is building maintenance. He's been with his company for 26 years. So that comes in handy with this house too, his building maintenance knowledge. I've heard of in-house financing. You can see it on the internet when you go searching for like different things, but I've never heard of a program like this. That's the difference between trying to find a landlord to work with you so you can have a place to stay versus a whole company. Right. You know what I mean? That specializes in helping home people who most likely wouldn't be able to get a traditional mortgage. Mm-hmm. So you know what I mean? And to help them actually be homeowners. But yeah, it was a fun experience. The game room came from the 17-year-old. I tried to be colorful. We call one room the gold room, one room the red room. So that came from my daughter. So, and then we kind of got carried away with it. Thank you so much.
Okay, so that's the video, Sarah, and as you see, that's what I was trying to communicate before, and to all of you guys listening me there, is this concept of the difference on the family's life, the stability, the ability to create, to have something that is very important for a human being, which is power of choice, right? Like a tenant does not have power of choice in his environment, in his own home and so on. So it's less stability. It's just a natural law. So this is what we are working towards, Sarah. And the main thing is that the $46 million that we recover in assets right now for the philanthropy investors, the average return of the portfolio is 11.14%. As of this year, it has been growing every single year. And then the average equity gain, which is the difference between what they purchased the home with what the home was sold to the family, is 25%. So that's what it is. And for the family, the main equity gain is also, it's more than 25%. So the family is the one that really wins the more, but everybody wins. And then just to close it up, I would like to just tell you that philanthropy investors have expanded in different areas, because in 2019, I had a different revelation for people that says, hey, as you, Sarah, that you say, hey, I am only in real estate, but I really want to diversify, as Dr. Forrest said, right? So is that, and then we have other verticals, because I discovered that there is 8% of the population in the world that is living in good air quality condition environment, 6,000 children dying from water-related diseases. The animal population has decreased 70% in the last 50 years. Like, there is many problems in this planet that I believe we need to fix before going to Mars or to look into other planets. Yep. And so that's why I expanded the space for philanthropy investors to want to change the water quality in the planet and save water, and then deal with the problem of 8 million tons of plastic going to the oceans every single year. So we have the companies, and in that case, they are PPMs in different companies and so on. So you need to be accredited investor and so on. But yeah, that's expansion on that. So with that said, thank you. And I'm going for questions and answers for the last 5 minutes that I have.
Beautiful. I think that most of the questions that I've been watching in the Q&A in the chat are, how do we get in touch with you? And so I see members of your team putting in contact info in the URL. So that's fantastic. So I'll say, Ivan, I really admire what you're doing, and actually remind me later, I want to put you in contact with someone else who has a really similar mission. I think there's a lot of synergies in what you guys could do together. They're doing one of these summits on Monday, so it's short notice, but you may want to talk there as well, because it's all about investing for the good of the planet, so could be awesome. And even though I'm in the apartment space, one of my partners there, Quattro Capital, they really focus on people. So purchasing apartment buildings and making them better so that the tenants are happier. There's more of a community feel. So they're also lending to that, stability, even though it's not stability in their own home, it's stability in an apartment building, but it's stability that they're going to be part of the community, really enhance the community, make the apartments nicer. And that is their goal in their apartment investing. So I think that's really cool of Quattro Capital, which is why I work with them, because a lot of times in the apartment space, it can be like, make it as nice as you can, jack up the rents as high as you can, and then like you're done and you're out. And this team has a similar mind of like, how do we create something really nice for the families who are living there? So Ivan, we have our next speaker, Mike, who's in the curtains, ready to come on stage. So go ahead and pass over. If there's any last thing you want to say to the group, I'll say, okay, great. I see you putting in your info and everything. I'll say thank you so much for coming and talking, and thank you for your heartfelt approach to investing and to looking for solutions in the world. And I think it's a good point you make about, like expanding what you're doing to the environment and water and trash and everything, because right now it's totally separated, right? or mostly separated, where it's investing, there's doing good. And so bringing it together will help people actually put their money into things that will be good for the environment. And I see these kind of things popping up, and it's really exciting to be able to participate in those. So thank you.
Exactly, Sarah. And that's the idea, it's just someone can have a stock portfolio, right? Someone can have a crypto portfolio, real estate portfolio. My vision is someone can have a philanthropy investing portfolio, helping 10 different areas in the planet and so on. So I am glad to be with you, Sarah, and thank you very much to all the listeners. Thank you to Mr. Marco and Dr. Forrest for the amazing knowledge they shared before, and looking forward, and the best for Mr. Mike coming up.
Awesome. Thank you very much, Ivan.
Bye, Sarah.
Bye. All right, everybody, we have Mike coming up. Mike is our, let's see, turning your video on for you, Mike. Mike is the final speaker for today. And then after that, we'll open it up for any longer question and answers that you guys have. So Mike, welcome. Thank you for being here. Oh, you're on mute. Let me see. Ask to unmute.
I have it. Thank you. Appreciate you having me. Thank you.
Yeah, thank you for being here. So what Mike does, I'm really excited, you guys, ties in like exactly to the title of this summit, the Confident Investor. So Mike's company, Appraisal Nation, is appraising investments. And so a lot of people that I work with, they have kind of a limit, or like they see something and they stop because they're not confident about the property or the project or the investment or the market or something like that. And they don't have the skills to do it, and they don't want to spend the time to learn the skills. And so they get stopped there. And so when you have someone on your team, an appraisal company, an appraisal team, they can do that type of work for you, with you, and remove that roadblock so that you can be confident in investing. So thanks for being here, Mike. And I'll hand it over to you, and you can introduce yourself and your company a little bit more.
Appreciate it. So as Sarah said, my name is Michael Tedesco. I am the CEO and founder of Appraisal Nation. Appraisal Nation is the largest appraisal management company in America that does private lending, institutionalized private capital. We do the valuations for about 65 to 70% of all institutionalized private capital. This includes companies, CoreVest, Finance of America, Blackstone, BlackRock, KKR. We're doing their valuation portfolios, all the way down to fix and flips. Arsenal Capital did 1,200 orders last month with us. Marco, who's on here, does valuation products with us. So we see we have about 3,000 lenders that we work with on a daily basis, and over 50% of our portfolio rests in private lending. And which ties in really nicely with our other 50%, which is GSE lending, retail, wholesale. We have about 10,000 brokers who work with us. The number 2 largest lender in America does their valuation products with Appraisal Nation. So we get a really good grasp of what's going on in every market. And we're able to aggregate that data and really look at markets and find out what the best markets are for investors. And that's one of the things that we do really well, is finding out ways to help our clients and what we can do to help people. One of the things I say to people quite often, I hear people tell me, well, my market is Chicago. I live in Chicago my whole life, and I only do apartment buildings in Chicago. I only do fix and flips in the suburbs of Chicago, or whatever the case is. And my question to them always is simply, why?
Yeah.
Why is your market Chicago? Why is your market this one small suburb? And their answer is, that's where I live. And I have to tell you,
because that's what they know. That's what they know. So
right.
Yeah.
And we all become creatures of habits. I'm a creature of habit. I shop at Costco because they only have 2 things and I get to pick just one of the 2, and that's it. I get it. But to me, my market is America. Okay, Appraisal Nation does every appraisal. All of them are done in every county in the country. And that's what we focus on. So I love to tell people that your market is only as big as you make your market. And there are opportunities to be had all over this great country. It is growing at an enormous pace. And there are renters in different states looking for opportunities and places to go at an enormous pace. And there should be investors to offset that. Presently, the real estate market, the housing inventory itself is at a 5-year, we are 5 years behind in building, which means that it would take us approximately 5 years to catch up on the demand that's out there right now. So there is a ton of opportunity for people to build. And what I'm seeing right now that's super popular that we're appraising are people building ground up communities, entire ground up communities, subdivisions, but these subdivisions are not being sold as one-offs. They're being done and developed and completed as entire rental communities. I'm talking single family housing communities, 300-400 home communities. And every single one of them, an investor has built and made a rental community, and they're single family rentals.
Very cool.
And that's happening at an alarming pace, something I've never seen. Not even in the last 5 years have I seen anything like I'm seeing in the last 2 years. So there's so much opportunity for everyone to have. And Sarah, if you can, I'm not keeping up with any Q&As or chats, but I want everyone to know if you want to chime in, if there's any questions, Sarah, if you moderate those, I'm happy to answer any questions as they have them.
All right, I will definitely do that. And Mike, do you have a presentation, or are we doing this conversation style?
I thought we were just going to do conversation style. I want to answer any questions that people have. I want them to know the value that Appraisal Nation can provide for them. It's more than just, yes, we can do appraisals. We do fix and flips and ground up and plans and specs and commercial properties. We have over 1,000 MAI appraisers who work for us. So we're happy to provide those solutions. We can do that. But it's so much more than just the 30,000 plus appraisals that we do every month. There's so much more to what we can provide. We can give you insight and data on markets. And, when you look for partners who you work with, they should be able to provide value both ways. And that's what true partnership does.
Yeah, I love it. And Mike, earlier, pretty much all the speakers were saying, when you're looking to invest, there's an order of operations for your due diligence. So if you're going to be passive, then first do due diligence on the team, and then do due diligence on the market, and then the property. And if you're going to be active, then you're going to do due diligence on the market and then the property. And so, a lot of people, I think that's exactly right. Like exactly where you bring the value is for those stages of due diligence. And even though it's not just that due diligence of like this market, but providing insights for people who, like here in California, we talked about, I'm not going to buy apartments in California. So I'm constantly looking at data on markets for a number of reasons, which we don't need to get into. But because that'll be a long, long rant on my part.
Trying to stay as politically center as possible for this conversation. So I didn't even want to bring up California.
Yeah. But, you know, when I am looking at other parts of the United States to invest in, I'm not going to each of these cities and, you know, boots on the ground doing due diligence. I'm looking at mass data that's out there and looking at other people who are doing, who that's their entire function is to do market due diligence, you know, like you guys are doing. So it's super powerful. And for anyone looking to get into real estate, like you need to really pay attention to the market. It's super strong. That's where you're going to make money or lose a ton of money if you misjudge them or if you time it just right. And, you know, we also talked about, Mike, earlier, you know, investing for different reasons. So investing for cash flow versus investing for appreciation, and how, you know, when people might choose one or the other. So I'd love to hear, like, when you're looking at your market data, do you guys kind of identify like this market? Like, how do you look at the markets? What kind of information, and do you say those sort of things like this is a good cash flow market, this is a good appreciation market, or how do you guys approach it?
So, right. So we can target markets using our data and say, hey, this is a great market for long-term rentals. The stability is there. The ROI is there. This is a really nice, solid market with nice cap rates. Or we can go, you know what? Actually, this market is even better for short-term rentals. And we find that this does extremely well. This market is actually more suited for fix and flips, or this market is actually really suited for ground up, just ground up construction, wholesale, and buying them and building them and spitting them out. So we can see that in many different markets throughout the country. And those markets change, and they've been changing so quickly, even month to month recently. I'll give you a great example. I purchased 11 properties in a very specific market in Florida. I bought lots to do ground up short-term rentals. It's a beautiful market. It has Gulf access. All the lots have coastal ways that go right out to the Gulf of Mexico. We were getting them at a great price. We were going to build these projects for $700. We were going to hold on to them for a 3-year period and do weekly rentals around $4,500 a week. The model worked great. The cap rate, everything was terrific on them. Well, over the last 3 months, what we've really noticed is even the lots that we purchased just 6 months ago are now worth more than double what we paid for. And we could talk about people who just randomly print money and how inflation's changing. Okay. And that it's not worth what it's worth. But the fact of the matter is these homes now are increasing at such an exponential rate that it changes the dynamic of how maybe we want to do these projects. So here we are building these beautiful homes that we were going to hold as short-term rentals. But looking at it right now, after the build is finished, I mean, we'll be 600-700 positive in equity on each one of them. So maybe the answer is we just flip them, right? So it changes the dynamic. So you have to look at your markets month to month and really understand, hey, what is the best market? What is my game plan? Is it long-term investing? Is it short-term? What are your personal goals? And identifying that's extremely important.
Yes, that is extremely important. And I mentioned earlier, and I'll put a link in the chat, you guys. We're doing a 3-day challenge next week, and that's exactly part of the process. Like taking a look at what are your goals and looking at over 15 types of real estate investing and saying, what is the right type of investing for me? Because like you said, if it's short-term, if it's long-term, if it's fix and flip, if it's, you know, what is it? What matches your goals? That's the next step. And then going out and finding the right market for your type of investing is totally key. So Mike, how do you guys do your due diligence?
Well, depending on what part, we actually have several parts of due diligence we have to do. So for example, on the appraisal side itself, specifically, if we're talking retail, we have over 30 staff appraisers who are sitting in that office, and they're reanalyzing the data that these qualified appraisers who have been in these markets for 20 plus years have already done. And then we have people who actually reanalyze their data also. So there's that part of QC, which is very important. And if it's a retail product, it's going off to Fannie and Freddie, who have automated review models that we're looking at those and making sure all of that's correct. So on the appraisal side, there are just layers and layers of quality control checkpoints that we're going through. And sometimes those cause hurdles that become a little difficult when we're dealing with timeframes. So that's important. On the investing side, it's more of an art than a science, if you would. As I mentioned, like with the appraisal side, it's really a science. They have it dialed in, they have automation. There's a ton of things that we do. There are qualified people who look at it. But on the investing side, I think it's more of an art. There are people who like certain things and they like to focus on those. So for example, I personally enjoy short-term rentals better than long-term rentals. The present economics of what's going on is a great example why, right? Even in California, short-term rentals are still very successful, but long-term rentals with moratoriums and everything else in place could be hazardous in certain markets.
Totally. Extremely, extremely hazardous. Yes. And even I'm seeing people in the apartment space, we're going from 7 to 10-year business plans to 2 to 3-year business plans. Because like you said, the market is shifting so quickly. So that's a hedge against risk, but also we're finding that we can reach the returns faster for similar to what you were saying, like things are just swinging and going crazy.
It's this, I always hear, oh, we live in crazy times. But in the real estate market, and I've been doing this a long time, in 1994, or 95, I became a very young loan officer. I was a 19-year-old loan officer. And by the time I was 22, a bank manager. By the time I was 26, I got into appraisal management and I started my own at 29 years old. And I've been looking at real estate now. I hate to say that, but well over 25 years I've been looking at real estate. And I've went through some crazy, I remember times where all you had to do, your phones were always ringing. You just pick up a phone and there was a loan sitting there and it was constant. And I remember the crash, and I remember, go pounding door to door, pounding the pavement of every lender, take them out to lunch, begging for business, but they didn't have the business because it just wasn't available. Mm-hmm. All those times, I have never seen anything like this in terms of inflation in the marketplace, in terms of the demand in the housing market. The supply demand differential right now, I can't remember anywhere nationwide as a whole that's been anything like this.
Yeah, definitely. And then stronger in some markets than others, right? So
definitely. And that goes back to market data, right? There are, I can tell you this right now, unequivocally, I would pick 5 states that I would say these 5 states have more demand and more need and more necessity. And people who are in New York or in Illinois or in California, which coincidentally are all blue, I'm not going to mention that, but should be looking at states like Texas and North Carolina and Florida. And, even Georgia's demand right now is through the roof. And that Southern belt is just exploding. And there's such good markets in that area right now.
Yeah. So we own in Texas, the Carolinas, and Georgia. For that reason, the markets are going crazy, and the supply and demand. And even we talked earlier about like the United States is not a real estate market, and even Texas is not a real estate market, right? Like you need to look at the cities, but certain cities in Georgia, the Carolinas, and Texas, certain cities, the supply and demand is so upside down, and that's where we're buying. It's like where there already is a housing shortage, and there's a huge number of job announcements. It's like there's no choice but for things to be going well for rental owners in those markets. And that market,
you just have to watch legislation. I think that's so key. So when you make the argument that, and I see Michael Rogers' statement there, 5 million houses are short. I actually think that number is probably short. As I look at data, like I said, literally builders could build for another 5 years to catch up with demand, and they can't. So that's where we are as a whole. But you have to worry when government wants to come in and try and fix everything, they don't realize that you turn one way and it has an effect on the other way, and it always does. So that's the concern for everybody, is that, the moratorium is a great example, right? I get it. There are people in need, but the more that you try and do that, the more it causes an issue on the exact opposite end of the pendulum.
Mm-hmm.
So that's something to be very mindful of. That withstanding, yes, there is opportunity for anyone who wants to put cash into the real estate marketplace. And my recommendation right now, by far, is building. I would recommend building even more so than fix and flips, which fix and flips are getting harder and harder to find every day. But now we're seeing a lot of tear downs. That's another big thing that we're seeing. People are coming in, they're buying a home from the mid 80s even, and just tearing them down.
Yeah.
And just starting fresh and giving a nice model to it. And that's really popular. But you can do a lot of affordable ground up construction projects, single family. You can do a lot of affordable multifamily projects. You have to be mindful when you get into the multifamily projects with obviously permitting and timeframes. All the places that we just mentioned, all the states that we mentioned, and we can get even more specific into the markets, are now having permitting issues because they can't keep up with the demand of the permitting. So, I mean, it's, we started projects, as I mentioned, I'll use my Florida projects as an example. 9 months ago, we could get permits taken care of within 90 days. And now we can't get permits taken care of in 180 days.
Yeah.
So that's the issue that you're running into. So when you look at a project, one thing I tell people in today's market, and this goes all the way back to what we do as a whole, which is obviously appraisals, is that expectations need to change. It just, as simple as the appraisal itself, there's no longer a 5-day appraisal. Okay. It doesn't work like that anymore. Loan officers would go out and go, oh, I can get an appraisal in 4 days, in 5 days. And they could in many markets. Florida, we were doing 4.5 days for years and years in all markets in Florida. And now we're running 9 to 11 days in Florida, right? Just to get an appraisal done. You keep hearing shortages, right? There's Roberta, the lumber shortage is also affecting the building industry. There it is right there, right? You see, the chip shortage is affecting cars right now, right? Everything you hear, there's a shortage on this. The personnel shortage, right? I've seen restaurants have to close. Fast food restaurants, national chain fast food restaurants have been closing for certain days because they have to give their employees a day off because they don't have enough employees to keep up with the shifts. Right. Yep. So shortages on everything right now. Mm-hmm. When you flood all these people into the country, and we're not going to talk about right, wrong. I'm just talking population growth. It causes more demand. There's more demand in everything. There's more demand in housing. There's more demand in sandwiches that need to be eaten. There's more demand in cars that need to be purchased. All of that has an impact. So, those are things that you have to look at. And where are these people moving? Where's the migration patterns? Mm-hmm. I referenced the Sun Belt. Huge. So popular. Yeah. Texas. The other thing, and I keep trying to avoid political statements here, but
bring it on.
Well, people are leaving California in droves. It's not a secret. People are leaving New York in droves. They're like, we created this nightmare of all these policies. I'm going to leave. And then they vote for the same policies. And that's a whole nother thing. But the point is, when they leave, where are they going? You have to look at the migration patterns, and they're going to Austin and Dallas and Fort Worth and Plano and Frisco, and everything surrounding Dallas right now is on fire, mm-hmm. right? And you can look at that. Yeah. You can look at, areas of North Carolina where the state capital of Raleigh has now surpassed Charlotte. And everyone knows, Charlotte, North Carolina. And no one really knows of Raleigh other than the state capital, but it now has a larger population than Charlotte when you look at the surrounding community, because families want to live there. It still has a good cost of living, still has good infrastructure. Everything's new. So there are such good markets, right? We mentioned Atlanta. Everything around Atlanta right now, you go in Atlanta, the traffic's a nightmare. It's so busy because everyone's moved in. They really haven't kept up with that infrastructure. But the suburbs, they're still booming. And that's just going on and on. And it's starting to trend down. You're seeing it grow in areas like Savannah, and you're seeing it grow. It's coming all the way down to Jacksonville, and Orlando is just insane right now. And when you go out to the west of Florida, I can't tell you how big Tampa is right now. I am such a huge fan of Tampa. I would almost want to put a Bucks hat on if I wasn't a Steelers fan. Like I am. I mean, Tampa right now, what they are doing in the real estate market, I mean, it's just unbelievable. And Southern Tampa, coastal Southern Tampa right now, everywhere from Tampa all the way down to Naples is a buy. It's just a buy. So, you know, my dad used to say, land, they're not making any more of it.
Yep, true. Yeah. And I'd like to say something about how you're saying like it's a great time to ground up development, but then there's the permitting issue. So, you know, we're talking about Georgia. There's a city in Georgia where we're buying an apartment building, and it already has like a 30% housing shortage. 30% of workers are displaced. They have to come in from outside. And there is ground up going on, but because of the permitting lag, it's like 2023 or 2024 before those will be on the market. And so it is a good time to buy in those markets, but also you can buy value add, buy something, fix it and hold it for short term, like the 3 to 4 years, and really have strong demand for your product doing that strategy as well.
I think creative financing is also, or I should say creative solutions. There's tons of creative financing if you need those options, but creative solutions in terms of what you buy. So for example, you mentioned, oh, there's an old apartment building or something of that case. Maybe because it's zoned that way, it gives you the opportunity to tear it down and make something bigger, and you can max out the zoning on it. Or something that's listed as multi-use, you can do the same thing, or you can expand. So look at, when you're looking to buy, look at, more important than what you're looking to buy, I would look where you're looking to buy and look how it's zoned, right? And how you can maximize the zoning on it. Mm-hmm. So that's really important as well.
100%. So Mike, I think there's 2 ways that this audience can really work with you, and the way that you can really provide value to them. And let me know if this is incorrect. But I believe one way is if people want to be active investors, they can work with you on the appraisal side. And then the other way is if they would like to be private lenders, they can engage with you for that path where it would be fairly passive for them. Is that correct?
That is absolutely correct. If you are a private lender, whether you're doing 1 deal or 100 deals a month, we would love to do your valuation business. That goes without saying. We are by far the #1 AMC in the private lending space. We understand that extremely well. Those products can be very unique. If you're working with one appraiser in one specific market and maybe you feel comfortable with them, that's great. But as you expand, finding appraisers right now is a nightmare. You need to have a team that you trust, and we are that team. So that is where we can definitely help you, is in your expansion efforts as you grow out. You know, you don't want to take the time searching and struggling for vendors when you have someone like Appraisal Nation who is there for you. And then that's as the lender. As you're doing individual deals, we can obviously help you with those as well. And then when it comes to market data, if you have questions, personally, I love sharing market data. It's a passion of mine. I'm happy to help with that individually. Sarah, you can give them my contact information. So happy to do that as well. I own 6 companies right now, and with the and obviously Appraisal Nation is my biggest company. But we'll do well over 150 million this year in sales, and we keep growing. So we love what we're doing. But with the exception of a nationwide gym franchise that we're blowing out, the other companies are all real estate companies. So I'm doing what you're doing. I understand what you're doing, and if I can help, I want to help.
Yeah, that's awesome. So for people who want to, because I see a couple of things in the chat and the Q&A. Do you have like a mailing list if people want to join to get like regular information or regular reports, or is the best way for people to contact you directly, or what's the best path?
I would say contact me directly for now.
Okay.
I've been asked many times to have a weekly newsletter or a monthly newsletter, but I think that as many people here who own businesses know, especially when you own more than one, it becomes very time consuming. Matter of fact, squeezing this call on, Sarah, I am literally in the middle of one of our build outs at our nationwide facility here in Cary, North Carolina. And we're doing a 30,000 square foot gym, and I'm in the gym doing a call.
I know. I appreciate that. Yeah. Mike was like, well, I'll be traveling, but I can pop in.
Well, I just came back from Texas last night. We were at the 5-Star event. We hosted an enormously successful party there at the 5-Star in Dallas, which is a lot of servicing. We also touch on servicing. So it's one thing to, keep in mind as you guys are lending and building, you have to service those portfolios also. Appraisal Nation can help you with that and get you the right people in touch with that as well.
Beautiful, beautiful. All right, guys, let's see some activity in the chat, in the Q&A. Let us know what you're interested in as far as, markets, appraising, lending, different strategies. Okay, so there's a question. What do you think of Lehigh Acres in Lee County, Florida? Do you know that market?
So this is interesting. I know I'm not specific into Lehigh Acres, but I know Lee County, and like everyone else, so much growth, but it's really changing there. It's really changing. I will say this: anywhere to me right now is a big buy. And I think Lee County is definitely a big buy. I think almost everywhere in Florida, with the exception of probably Miami, in my opinion. And that's just me personally. We're talking about my personal portfolios and what I enjoy doing. I would stay away from major urban areas right now. But any sort of suburb or exurb is a big buy to me.
Beautiful. Thanks for that. Another question from Stacy. Can you help me understand how you can bring value to private lenders? Is it just with valuations, or do you also help connect lenders to folks who need the loans?
We can also connect, absolutely. So we have 3,000 lenders we work with. And what Appraisal Nation has done so differently than any other appraisal management company in the country is that we've actually built individualized relationships. It's very important for us when we get out there to connect, to actually make a relationship, to build a connection. So this is why me as a CEO I'm here on this call, introducing myself, telling you I'm here for you, giving you my personal cell phone number. I want people to have individualized relationships that can grow together in time. And we do the same thing with our lenders. And over the last 15 years of doing that, we've created some pretty strong relationships. So if you tell me the product that you like and where you're doing it, I'll say, well, here's about 4 or 5 lenders who I think do really well in that area for you.
Yeah, that's beautiful. So that's the same in whether you're looking to be a private lender, a debt investor, or an equity investor, always creating those relationships. And in this space, like, it's all about relationships and connecting and being clear about what you want, so someone else can connect you to what you want. So, if I say, hey, Mike, I'm not really sure what I want, he doesn't know what to connect me to. But if you're really clear, like, I want to be a private lender in, this type of market for this, then he can connect you.
We can also connect you to the capital too. So, it's very interesting. We talk about interesting times. There's so many people who have plenty of capital they don't know what to do with these days. But there's still plenty of people who say, I have a great model, but I need to find that source of capital that can funnel all these loans for me and funnel the build out for me. And we can connect you with that as well.
Yeah, that's super, super helpful. Did that answer your question, Stacy? Hope so. All right, anybody else have questions for Mike? Okay, Stacy says, yes, thanks. That's what she wanted to know. So there's a request for your cell phone number. I don't know if that is what you want to share. I shared your email.
I do not mind. Looks like there are 132 of you. Don't all call at this exact moment, but yes, that's fine. And feel free to text and we can get to know each other. And if I can help with anything, I'm happy to. And there you go. That is my personal cell.
There you go.
919-867-9400.
I think you sent that just to me, so I'm going to put it to everyone. All right, you guys, there you go.
But again, a lot of great markets. If you're looking at building, if you're looking to say, hey, what do I want to get into? I love ground up right now. If you can find great deals on lots, I highly recommend it. There's still a lot of fix and flips to be had. You just have to do a little more digging.
Yeah.
Contractors, we talked about shortages. There are shortages on contractors, there's also shortages on contractors and their employees and their staff. So the GSEs, all those GS guys, they're struggling, the GCs. So getting good quality workers, that's also an issue. So just be mindful, expectations have changed. And that's what I was trying to allude to when I said, this is a 5-day appraisal anymore that's taking longer. Everything's taking longer. Permitting's taking longer. Build outs are taking longer. Contractors are taking longer. It's just everyone's very backed up. We've seen it happening from every end. The supply, the demand is so offset. You have a population growth coming in that's not, and the quicker that population growth comes in, we are not keeping up with the housing demand of it. So right now we're at a 5-year lag on inventory. Mm-hmm. If the rate of growth continues as its present pace, we could be a 7 to 8 year lag by the end of next year. So we need to find better building solutions. So that's why again, ground up construction for everyone. Let's all build.
Awesome. Okay, so Mike is asking, do you also do BPO outside appraisals for note purchases on single family rentals?
We do. I'm not a fan of BPO products. I don't think they're going to lead you to the most accurate value, but we do them. We also have a hybrid model, which is really nice.
What is BPO for those who don't know?
Broker pricing opinion. Basically, it's a value given by a broker. And the problem that I have with that is brokers make their living off of commissions on homes sold. So the higher the home is sold, the more commission he makes, the more money he makes. So when a broker does a value, they've spent their whole life looking at the absolute high end of that home because they want to make the most money they can make. And sometimes that can be a little deceiving when you actually have an appraiser who's trying to give you a fair market value of it. Or, if you're a lender trying to lend on it, do you really want the high end of that home from a broker? So, you want to make sure you're hanging your hat on the value of that home. You're securitizing on what that value comes in at. I don't know if having someone who makes their living, the more it's worth, the more I make, having that person tell you the value of it.
Yeah, and that goes right alongside what all the speakers were saying today. When you're looking at your extended team and all these areas of investing, really think how their interests are aligned, because even the most, subconscious bias is super strong. So really,
follow the money. Mm-hmm. So, that's just, that's a rule of thumb for life. You can follow the money with anything and always come back to the answer. But I see Michael here. I agree. BPOs aren't the best. How else can you truly value a house? Well, the best way is an actual appraiser. They are far and away the most experienced people, more experienced than you or I. We could be building in areas for 20 years and they're just going to know more. They have dedicated their entire lives in the valuation process and they're completely independent, completely unbiased. They have no dog in the fight. And I highly recommend a full valued appraisal, even if it's just a drive-by. You're still going to get a good understanding of that property. You can get it at a reduced cost where you don't need a full interior appraisal. That's a much better solution than a BPO, is a drive-by appraisal by an actual appraiser. We have hybrid models, which an appraiser does a cursory review of, which is also a better option than a BPO. But the best is obviously let an appraiser come in, let him look at the inside of the home. You're about to lend hundreds of thousands of dollars on it if you're a lender or build. And we can do plans and specs appraisals from ground up to give you an idea of, hey, when this home is done, what would it be worth? I would rather have an appraiser tell me that. And as someone who has 26,000 appraisers who work for him, I still get appraisals on my properties.
Awesome. Thank you for that. Another question from Joel. He said, will you consider appraising a house that has already been foreclosed on to get the true value?
We do it every day. We do it every day. We do it for Fannie. We do it for Freddie. We do it for everyone. Now, the one thing I would that I question in certain markets, some people love using REO comps on REO foreclosed appraisals. I'm not a huge fan of that. I think that if the property is in similar condition to the neighborhood, then the present comp should be utilized. So it just depends on that, but that's another conversation that we can look at.
You're welcome, Joel. All right. Question about is pricing for all these services we're talking about. Is it listed on your website?
It is not. So it's very county dependent right now, because I will tell you this. Our prices are probably the most fixed pricing in the country in terms of AMC. Most AMCs charge a margin and they try and maximize that 40% of a margin off what the appraiser charges them. We are a fixed $125. So if the appraiser charges us $1,000, we'll say for some crazy property in California, our fee would be $1,125, where another AMC would be $1,400 because they're charging 40%. So we charge $125 fixed. That's our price for our QC, our managing, our controlling that process for you, our housing of that appraisal for the life of it for you. That's what we do for you. But it is county. You can get a quote. If you are a larger lender, if you're on here and you're a slightly larger lender, we do give fixed pricing by state, and we can do that for you.
Awesome. Cool. So what else, you guys? What else do you have questions around? Oh, okay. Here's a long one from Alexandra. Do you see that one, Mike?
Yeah, I think they're arguing BPOs. Let me see here. I'm a managing real estate broker as well as an investor, and I got into doing a BPO since 2012. I started back in 2008, but I could get a true, clear understanding of local market shifts and valuations. Realtors get a bad rap. My niche, unbiased BPO certification is making investment decisions. Okay. Well, I'm not disagreeing with Alexa. Maybe she is, but there are also 100,000 other ones who may not be in the same unbiased niche certification of making good sound decisions like you are. So I agree with you. I think that as a whole, we have to look at, I mean, we're talking about countries everywhere.
Yeah.
Or markets everywhere. Yeah.
Yeah.
Well, I'd like to ask her, what market are you in? Can we ask her that? I'm curious. Chime in and tell us what market she's in. That'd be interesting.
Yeah, let us know, Alexandria. Chicago.
Oh, okay. Yeah, there's a lot of deviation in Chicago right now, a lot. So that's good to have a good agent in Chicago. There's another one by Joel Stevens. I see something here. Getting I agree. It's such sizable. Is your turnaround time somewhat faster than normal? Yes, we are running faster than our competition. We just had a study done by multiple lenders who use multiple AMCs, and we found that we were 2 to 3 days faster on average, and we're still probably 7 to 8 days longer than we used to be. So over pre-COVID numbers, from post-COVID numbers, nationwide, the market has shifted almost 2 full weeks. So that's just something to consider, but we do run a few days faster.
Everything is taking longer. Everything, even like getting the commercial loans for our multifamily, what used to take 3-4 weeks is taking upwards of 90 days. Yeah, everything's taking longer.
Interesting from Selena, who said a huge backlog of appraisals. So Selena, you'll like this stat. 2 years ago, we did a study. We sent it out to all 26,000 of our appraisers, and we asked them, how much work is on your desk today? 5 days was the answer 2 years ago. This was 2019, beginning of 2019. We could not even get our head around what was going on. So we sent the exact same survey out in February. And astounding, the average was 45 days of work is now sitting on their desk. Think about that. The average appraiser has 45 days of work on his desk right now.
Wow.
Yeah.
Huge difference.
Yeah. Yes, we do appraisals on mixed use property. Someone asked that question just now. We have over 1,000 MAI appraisers. So we do commercial, we do mixed use, single family, 1 to 4. We appraise, as the name says, appraisal nation. If it's in the nation, we appraise it. We did well over 30,000 appraisals just last month. We also did a couple thousand BPOs. We also did about 700, 600 commercial projects. So yes, we appraise it all if it's inside America. We also do Puerto Rico. We'll do Guam. So we help in different markets like that as well.
Awesome. Well, thank you, Mike. Is there anything that you'd like to, any wisdom you'd like to impart on all the attendees who came because they want to be confident investors?
Again, I'll go back to my original statement. Don't box yourself in by calling your home your market. The world is as big as you make it. And it is a great big world that we are in. And there's a lot of opportunity to be had. Don't be scared to go out there and try something new somewhere new.
Yeah, and I totally agree. Whatever you're doing now and are successful at, in 5 years, it may be different. So it's that advice is for life.
Yes.
Shift, pivot, exactly. Cool. Well, thank you, Mike. I appreciate it. Everyone, I see more questions around Mike's email and phone number. It's in the chat. And then also when I send out the replay, I can include it there so that you guys who didn't grab it can grab it. And if no one has any last questions for Mike, I'll say thank you, Mike. I know you're in the middle of, of a build and all kinds of stuff.
I got about 130 pieces of equipment here that I have a team doing the build out. So I have to go just check on that.
Yeah. Okay. One last question before you go. Are you guys going to Note Expo in Dallas, November 5th, 6th?
We are not going to the Note Expo. We have a conflict with that. We actually, pre-COVID, we did about 54, 55 conferences a year. So we have a team running everywhere. And when we talked about relationships and how I want to be on the forefront of that relationship, building that, I try to go into as many of those as possible. I think in 2019, I did 60 trips in 2019. So we are going back out a lot. I think I've already done 20 trips already this year, 22. And I have 5 this month. I have 4 next month. I have 3 in November. We are not doing that one. However, let me recommend for everyone here, if it hasn't been recommended, and I know Eddie Wilson's a part of this, the American Association of Private Lenders, their AAPL conference is coming up in November. It is the biggest recommendation I could give any investor or private lender. What you will learn, the context you will meet, the opportunities that will be there, it's worth every dollar you'll spend. And we'll host a big party there. You can come get some free drinks from me, and we can chat there as well.
There we go. Sounds awesome. Well, thank you, Mike. I appreciate your time. I appreciate what you do for investors. And I appreciate that you are open to sharing, ways that people can personally contact you if they want to move forward in feeling more confident about their investments by expanding their team to great team players.
Sarah, thank you for having me, and good luck to everybody.
Thank you, Mike. All right, everybody. So Mike was the last speaker of today. And so with that, we'll wrap it up. And then I'll let you know tomorrow. Mike, where is the private lender conference? If you look up on the AAPL website, so AAPL is one of the sponsors of this event. If you look it up on their website, they have their events listed there. So that was the last speaker of today. I hope you guys learned a lot. I am totally impressed by those of you who have been on for such a long period of time. I hope the knowledge that you gained was extremely valuable. Tomorrow, we're going to start again at 8 a.m. Pacific, and we'll go for another 4 hours. And who do we have tomorrow? So you're at 7 a.m. PST, you'll get an agenda with who the speakers are and their topic. I will let you know that it's going to be the 8 a.m. topic for me is I am extremely passionate about. So most people don't like it, but I think it's one of the most wonderful things to talk about. It's taxes and legal. And a lot of things are shifting right now. So John Heyer is going to be the first speaker. He's going to talk about what is shifting. What do we need to know as investors so that we don't do what worked yesterday in an environment tomorrow where that strategy may not work? And how can we get involved with things that are going on in the political world that disrupt our investment plans that we made in the past, and how it's going to disrupt our plans for the future. So I encourage you to be there at 8 a.m. We also have Derek talking about if you have IRAs, 401ks, how you can invest those in all the different types of investments we were talking about today. Currently, you can use your IRA to invest in those. Things may change in the future, but it's going to talk about with your IRAs and your 401ks, how can you create a really solid investment strategy with those? And we're going to have someone talking about tax liens, how to really confidently pick and choose and invest in tax liens, how they work. And so it's a great lineup. So we will see you tomorrow at 8 a.m. Pacific. And until then, goodbye, everyone. I'll stay on. I see a few more questions, but other than that, that was the planned content for today, and we'll see you all tomorrow. All right, so question, private lender info again, please. So American Association of Private Lenders, if you go to their website, you can find everything. You're welcome, Rob. You're welcome, Roberta. You're welcome, everybody. You're welcome, Selena. You're welcome, Susan. I am so happy you guys enjoyed this. And yes, Wendy, this was recorded and it will be sent out on Friday, and you'll have time to watch it over the weekend if you want to watch it again. You're welcome, Peter. You're welcome, Satish. We will see you all tomorrow. Thank you, Curtis. You're very welcome. Oh, Pamela, good to see you. You're very welcome. Oh, everybody, what kind things to say. I appreciate it all. I appreciate it all. Yes, Christine, it's going to be a really great session tomorrow around the tax and the changes. Susan, chat is enabled. It looks like you're choosing host and panelists to speak to instead of everyone. Phyllis, you are very welcome. Wendy, you're welcome. All right, everybody, have a great rest of your day, and we'll see you tomorrow.